Ladies and gentlemen, good morning and welcome to the third KDI School World Bank Conference on Fiscal Policy for Enhancing the Effectiveness of Subsidies and Fiscal Rules. My name is G.A. Park and it is my great pleasure to serve as your MC for this conference. As we begin the second day of this two-day event, I would like to extend a warm welcome to all participants, whether you joined us yesterday or are attending for the first time today. This conference, co-hosted by the KDI School of Public Policy and Management and the World Bank, provides an invaluable platform for policymakers, scholars, and practitioners to exchange ideas and share insights on enhancing the effectiveness and sustainability of subsidy, policies, and fiscal rules. Today's sessions will focus on fiscal rules with presentations and discussions led by distinguished experts, as well as interactive sessions designed to engage all participants. We look forward to your active participation and the diverse perspectives you will bring to our discussions. Our program today includes 3 sessions, a fireside chat, and will conclude with a summing up discussion at the end of the day. We are now ready to begin session 4, entitled The Fundamentals of Fiscal Rules. And in this session, we will explore fiscal rules which have been adopted in various forms by countries around the world to promote a sound fiscal management. I would now like to invite the moderator for this session, Dr. Jonghyun Lee, Associate Professor at KDI School, along with our speakers, Dr. Fernando Andres Blanco Cosillo and Dr. Franz Uli Roof. Dr. Lee, the floor is now yours.
Right, good morning. Okay, so I'm so happy to be here with all the experts from across the Pacific and from the across this peninsula. Unfortunately, if you miss the episode 1 of this nice show, I'd like to recap what the Professor Won Hyung Lim said in the summing up session. So yesterday we talked about many issues regarding the subsidies, and he actually emphasized we need to focus on 3 major aspects of subsidies. So he pointed out that there are huge economic aspect and some political aspect, and also there are some data issues. And also from the content-wise, he pointed out that the when you design or implement the subsidies and the programs regarding that, it is very important to think about the context around it, right? So the context-based design and implementation of subsidies is so important. Like the if you remember that the Dr. Min Ho Kim yesterday talked about the SME subsidies, and he proposed the bespoke kind of customized subsidy programs. That is quite brilliant to me. And also we need to think about the dynamic evolution. The things right yesterday might not be applicable today, right? So depending on the situations, we may want to adjust, transform, or augment our system to confront with those changes. And also lastly, the coordination with other measures is also important issues that we need to think about it in practice. So those are very relevant issues for today's topics as well. So to get off the right foot, we can open up today's sessions with the nice overview of fiscal rules. So we invited 2 best experts in fiscal policies. So Dr. Fernando Blanco, the lead economist at the World Bank, and also along with Dr. Franz Roche, a senior economist at the World Bank. So we are going to listen from them about the brief overview and also what are the things that we need to think about throughout this day. So Dr. Fernando Blanco, can you start off? Por favor.
KDI, because the seminar is wonderful seminar that we have yesterday, and expect that today will be also as interesting and as yesterday. And also I expect to have a great dinner like yesterday we have with the team. I will present the the basic issues on fiscal rules, my colleague Uli will present more empirical work on fiscal rules. So our presentation is divided in seven blocks. The first block is why fiscal rules are needed. No, it's a little bit how why fiscal rules became an instrument that is used across the world. The second is more a definitional things. What do we understand for fiscal rules? What are the type of fiscal rules that we have? And then I will conclude with the design aspects for having strong fiscal rules. and then my colleague Uli will cover the issues of how rules need to change in special circumstances, why we need adaptable fiscal rules. And then we will have the two last sections that are more empirical. The section 6 with more empirical work showing how is the commitment to fiscal rules, and complete with some concluding remarks. So I will begin with the reason for fiscal rules. And basically, from a theoretical point of view, fiscal rules are intended to correct or attenuate what we call the fiscal bias. What is the fiscal bias? I will do a little digression on how this fiscal bias appeared in the literature, and basically it is related to a problem that economists in the 1970s identified as the time inconsistency problem. The work of Kindland and Prescott, they won the Nobel Prize for the work that they did on time inconsistency, saying that normally policymakers, when they are and it was referred more to monetary policy, in periods of recession, the central banks in the world needed to increase, to reduce interest rate, to expand economic activity, to stimulate economic activity. But what they needed to do when you have an expansionary period is to do exactly the opposite, to reduce aggregate demand by increasing interest rates. But the fact is that when you are in a good economic period, few central banks want to increase interest rates because it's more popular to maintain the good the good behavior of the economy. So it was difficult for policymakers in monetary policy when they need to increase interest rates to attenuate the increase in aggregate demand to do it, because it was not popular. And what this generated was an inflation bias. Because as agent knows that the central bank will not react in good times increasing interest rates, there is a tendency to increase inflation. And this is what we call time inconsistency. When you promise in the future that you will do the adjustment, you don't do when you need to do it. And this translated in fiscal policy generated what we call the deficit bias. That is exactly the same. When a fiscal policy manager is facing a recession in his country, what he needs to do is to expand, to do expansionary fiscal policy. But he promises that when things will improve, they will do the fiscal adjustment. And this, again, didn't happen in most of the cases. And this is what we generate the deficit bias that is linked to a time inconsistency problem that everybody has. And the way to correct the deficit bias or the inflation bias in monetary policy is to have rules against discretion. And this was the seminal work of Kindland and Prescott that say, okay, how we can avoid this or inflation bias or this deficit bias triggered by time inconsistency problems. We need to have rules that when you apply the rule, in monetary policy, where the inflation targeting regime, for example, is a way in which central banks need to react to different shocks that they have. In fiscal policy is more or less the same. When you have the recession, it's okay. You can increase expenditures, you can have higher deficits. But you need to correct these deficits when you have an economic upturn, because you will have more revenue and you will contain. And because human nature, they don't do that, is why we have fiscal rules, propose fiscal rules in this way. So that more or less is the origin at the analytical dimension of what we need fiscal rules. But also we need fiscal rules because because countries have a lot of debt. If we see here, the graph that we have is that after COVID, countries increased their debt in a significant way. And one of the issues that were discussed at the time of COVID is exactly that as governments needed to react to these shocks, they needed to implement expansionary fiscal policy. And everybody said, okay, the COVID is a demonstration that fiscal rules don't work, because when the government needs to expand the fiscal rules, if you have a debt rule or a deficit or a fiscal balance rule, will avoid to do that, but we needed to do that. So in several countries, they say the COVID case is a demonstration that fiscal rules are too rigid, and we need or to drop them, abandon them. And during a 2-3 year period, everybody says, okay, is the debt of fiscal rules. But given the increase in debt, everybody knows that now some fiscal discipline needs to be imposed. And again, there is a new wave of fiscal rules that are more flexible, that try to do two things. First, ensure fiscal sustainability, but at the same time, ensure that, that the new frameworks to be more flexible. So you see this graph, and it's very clear that countries have high risk. Several countries are in debt distress, and some fiscal discipline needs to be resumed in fiscal policy. And this is why we have the fiscal rules. But the experience that we have on fiscal rules is mixed. What is the result? Here, this graph shows the proportion of times in which governments have deficit. And we see that at the global level, there is a small difference between countries that have fiscal rules of countries that don't have fiscal rules. In advanced countries, this is more clear. The difference, countries that have fiscal rules have a better fiscal, lower deficit, or they have deficits in a lower proportion than countries that don't have fiscal rules. But in MDs, the evidence is exactly the opposite. So it's something that we discussed a lot. I think that Uli will discuss, is the real effect. What is the performance of fiscal rules that for me still is mixed. So, but there is something that is very clear. While the performance in terms of debt, indebtedness, or balance is not conclusive on the role of fiscal rules, what is very conclusive is that countries that have predictable rules-based fiscal management have lower borrowing costs. And this is a graph from colleagues of the World Bank that worked at a paper showing that countries that have fiscal rules, independent if they comply with the fiscal rule or not, have at least 300 to 400 basis points lower borrowing cost. And you see the graph, the countries that have fiscal rules are the countries that are in blue, and we see that there is an effect that they call a spread compression effect of fiscal rules. And this is something that it is very clear. There is another paper of the IMF, very recent paper, showing that countries that have fiscal rules, and their fiscal rules include automatic correction mechanisms, they have an additional gain in terms of spreads of 100%. So as we know, fiscal rules are also an important tool for signal your commitment with fiscal discipline. So now, after trying to convince you that fiscal rules are needed, we can discuss the second part, that is, what are fiscal rules? And the definition, the classical definition that we have for fiscal rules are policy instruments that impose long to medium-term restrictions on fiscal variables, and these restrictions are defined through numerical limits on key fiscal variables. These key fiscal variables are debt, fiscal balances, expenditures, or revenues. The idea is that these fiscal rules impose these numerical restrictions to these variables that you want to control. And other definitions that are very complementary and very consistent with this broader definition. It says that fiscal rules also help to build durable political and social consensus on fiscal discipline. And that is one of the roles, is more a convincing role to everybody that fiscal prudency is needed. This other definition is very related with the other, is that fiscal rules impose a commitment for policymakers to, to devise and to maintain fiscal sustainability. And other role of fiscal rules is the stabilization rule of fiscal policy, that you say, if you have a very clear, credible fiscal framework, you can do countercyclical fiscal policy. In recessions, you can increase your expenditures or increase your deficit with the commitment that when you are in an expansionary period, you need to correct that excess of bias or deficit bias and reduce your deficits and reduce your debt. So it's, and this helps you to attenuate the economic fluctuations with counter-cyclical fiscal policy. And finally, as I mentioned it before, and just to show that the graphic in which I showed that countries that have fiscal rules face lower borrowing cost is a signaling device for markets. And this is other role of fiscal rules. And from a more fiscal policy management perspective, I would say that fiscal rules help and support to achieve the objectives, the general objective of fiscal policy. The first objective of fiscal policy is pretty clear, no? Is the fiscal sustainability. And also, if you have long-term pressures on fiscal policy, this can help you. You need to take into account in your fiscal rule. The second big objective of fiscal policy is output stabilization. And as I mentioned it before, fiscal rules can help you to make your policy countercyclical. The other important fiscal policy objective is risk management. Given the multitude of shocks that we have, this role of fiscal policy is every day more important. And fiscal rules can help you to have a more effective risk management. With flexibility in your fiscal rules, you can have escape clauses, etc., that gives you the opportunity to attenuate shock and do a proper risk management policy, fiscal policy. And finally, if you also have, if fiscal policy is also important for achieving development goals, fiscal policy is also very important for that, and fiscal rules can help to do that by generating the fiscal space for investment, for human capital expenditures that you need for achieving your long-term growth. So basically, fiscal rules are very consistent and can be a very good instrument to achieve these four main objectives of fiscal policy. And as I mentioned it before, and the lesson that yesterday we agreed is that, okay, fiscal rules can be useful, subsidies can be useful, but the design and the implementation of fiscal rules is more important than just the general thing to say fiscal rules are good. Fiscal rules are good depending on how they are built, and we will show how the design of fiscal rules is important for achieving or for trying to ensure these four objectives of fiscal policy. So a little review of the type of fiscal rules. I think that most of them are well known. Basically, fiscal rules are, you have four main types of fiscal rules: balance rules, debt rules, expenditure rules, and revenue rules. And both, and as with our definition, that are numerical constraints on these variables, you see that you can have balance rules that say, okay, you cannot have a deficit higher than 3% of GDP. Debt rules, your debt cannot exceed 60% of GDP. If you have an expenditure rule, you can say expenditures will not grow at more than 3 percentage points in real terms, or revenue rules that say, okay, you need to collect more revenues because you need to finance your expenditures. So these are the four generic type of fiscal rules. And basically, depending on the fiscal rules, the objective is a little bit different. And we have debt limit rules that basically the main objective is fiscal sustainability. This is the main device. The other good characteristic of debt rules is that they are very simple and very transparent. But the downside of these rules is that they promote procyclical fiscal policies, and the countercyclicality of fiscal policy becomes affected with that rules. And I would say is in terms of the size of the public sector, that can be other objective, control the size of public sector, that rules are not are neutral in that objective. If you have if you assess overall balanced fiscal rules, you can say that again the role of sustainability is important. It's less important or less clear than in the case of debt rules, but are still the most important objectives. Are also very simple, so easy to transmit, easy to communicate, easy to monitor. And the downside of these rules are, again, that they are countercyclical. They are not countercyclical. They are more procyclical. And in terms of the size of the public sector, they are neutral, because if you need to follow a balanced rule, you can increase, and you have a deficit, your expenditures are growing more. You don't need to reduce your expenditures. What you need to do is to increase your revenues, and the size of the state can increase. So there is no clear signal on that. A second type of rule that comes from balance rules, other type of balance rules, are the ones that are on observed balance. That is what the most common. But also we have structural balance rules. Structural balance rules help to ensures that the fiscal management will be countercyclical, or the role of stabilization will be more important, because structural balance rules tell you that you can spend money when you have a recession, or you can expand your deficit when you have a recession, and do the opposite when you have the expansion. So the stabilization role of structural balance is very strong. Is very strong. And also, if you assume that cycles are symmetric, also structural balance rules can help you to ensure fiscal sustainability in a lower degree compared to debt or balance rules, but still have a sustainability impact. The other thing is that positive aspect of fiscal balance or structural balance rules is that they tend to control the size of the state, because in expansions you do you contract your deficit, your expenditures, and you have some I would say more stricter control of the size of the state. But the downside of these fiscal rules are that they are not simple. Not simple. There is a lot of debate on how you need to do a countercyclical or a structural fiscal balance. There are several technical problems, but the most important problem is that are difficult to communicate to people. It's difficult to interpret, and also can generate a lack of transparency on the way that is calculated. So that is the downside of structural balance rules. And the expenditure rules have one of the main effects or objectives of expenditure fiscal rules is to control the size of the state. So you have the objective of control the public sector is more important, but also can help you to ensure fiscal sustainability. The good thing that they have a good effect on countercyclical fiscal policy. We will show later how expenditure, a well-designed expenditure rule can mimic the effects of a structural balance rules, but with the difference that are not complicated, are more simple, and of course ensure fiscal sustainability. So we have this, as I mentioned it before, depending on the type of fiscal rules, or depending on your policy objectives, you can have different designs of fiscal rules. And other important thing is that you can combine fiscal rules. And this is what countries are doing, combining at least two fiscal rules to ensure that, for example, you can achieve at the same time sustainability and countercyclical fiscal policy. This this brings me to, here are the definitions, the explicit definitions of each type of rules. Balance rules. In balance rules, you can target the observed fiscal balances or the structural fiscal balances, but the idea is that that the variable under control are the fiscal deficit or the fiscal balances. The same with debt rules, expenditure rules, and there are more definitions on the, the formal definitions of these 4 types of general rules are there. And I would, I would like to mention that there is an evolution of fiscal rules. No? That, as I mentioned it before, the origin of fiscal or what we call rule-based fiscal management comes with monetary, in the first place with monetary policy. I would say that monetary policy is always at least 10 or 20 years before fiscal policy management. They were monetary rules or monetary policy was the origin of this deficit bias or time inconsistency. Then monetary policies in the early 1990s, they created the systems of fiscal, I would call fiscal, monetary rules translated in inflation targeting mechanism, and that was an evolution. Fiscal policy came 10 years later in the 90s to say, okay, we can do the same in terms of rule-based management, and we established these fiscal rules in the early 90s when we have the expansions of fiscal rules. And again, in terms of institutional development, monetary policy was always ahead fiscal policy. The creation of monetary councils to control how the central banks execute the inflation targeting mechanism were already in the 2000s, while fiscal councils appeared only in the 2010s and now are developing. So we are at least, I would say, 10 years behind monetary policy in terms of improving instruments, improving institutional arrangements. And what we see also in this evolution of fiscal rules, that, for example, expenditure rules became much more popular in the since 2010. And the first rules were the balance rules and the rules that were very, very common. And you see how countries increase the adoption of different types of fiscal rules. And you have this evolution in which debt rules and balance rules are becoming less popular, and more expenditure rules are becoming more popular. And we see that in what I would say three generations of fiscal rules. The first were basically based on the objective of fiscal sustainability was the most important. And here we have the European fiscal rule, or the typical 60% on debt, 3% deficit ceiling, that several countries adopted, independent of their debt situation. If they had high debt or lower debt, the idea was to more or less copy and paste the regulations of fiscal rules. And nobody can explain me why 60, why 3 are the numbers. I think that in the case of Europe is because they wanted to arbitrage a bit, saying, okay, we will not bother Germany that has a debt that is lower than 60%, but we have a lot of Italy's of the life that have higher debt. They wanted to put it to the 60 level. The same with the deficit was more or less looking to the countries' debt levels to define the popular 60%. But when I go to emerging countries, they have this same rule, 60%, and they don't know why they define it the 60%. Normally, they say, okay, Europe is doing well. We need to follow them, and for one reason, they should have the rule. I do this with the US. No, I say, when I don't know why I am doing something, they say, okay, the Americans are doing better than me. They should be right. So I follow the rules without any any more formal or objective criteria. But that was the first type of fiscal rules. Everybody go into that. And the big problem was that you have a procyclicality on that, because when you need to do a fiscal expansion, and if you are close to the 3%, you cannot do that. And this generated a lot of criticism to the first generation of fiscal rules. And the criticisms became very, very strong after the global financial crisis and the Eurozone crisis in the early 2010, when countries couldn't do expansionary fiscal policy or countercyclical fiscal policy because they had the rule. And then emerged a new type of a new generation of fiscal rules that are basically the structural balance rules that allow you to attenuate shocks in principle. And this was in the 2010 to until COVID, these were the second generation of fiscal rules. Everybody was happy with the with this stabilizing role of the fiscal rule. But in 2020, COVID came, and countries that needed more stimulus, much more stimulus than a countercyclical or structural balance rule will provide. They need because the type of shock of COVID and further shocks were much stronger and much extraordinary than a cyclical fluctuation of GDP, in which the structural balance rule does a good job. So they need additional flexibility. And then I would say from COVID to now, we have a new generation of fiscal rules that keep you, preserve the flexibility of structural balance rules, but give you additional leeway if you have, if countries are facing extraordinary shocks that are not cyclically, there are not cyclical fluctuations. So you have this type of new fiscal rules that I will define later, are fiscal rules that help countries to cope with impacts of natural disasters or major global shocks. And these are what I would say, the new generation of fiscal rules. And basically, as I mentioned it before, between the first and second generation, the difference was the ability of fiscal policy to do structural balance rules. But as I mentioned it before, it's very clear that the structural balance rules are much better than the first generation of fiscal rules, than debt or balance rules. But they are very difficult to implement and to monitor. First, you have technical problems in which my colleague Uli is a master on doing that. How you the trend, how you separate cyclical fluctuation than the trend. There are a lot of technical difficulties in doing that. So for many countries, especially for developing countries, it's very, very difficult to have a good the trending of GDP and do the right thing with your structural balance rules that will ensure you this flexibility. So as it's very difficult to implement, one practical solution was to use a combination of rules, a combination of an expenditure rule with a debt rule. What the expenditure rule does. The expenditure rule, normally, if you do well, you define you will limit, you will impose numerical constraints to the growth rate of the expenditure, of the government expenditure. And on that, if you define the numerical limit for the expansion of expenditures at the level of the potential GDP, or if you have more ambitious objectives and you want to reduce the size of the state, saying, I want to limit my expenditures at a level that is lower than the GDP growth, so the size of the state in terms of GDP will fall. So you can define that, and this helps you to counteract, because if you are growing below your potential growth, if you have an output gap, you are allowed to spend at least at the level of the GDP, or the potential GDP, and you will have this counter-cyclical effect. In the opposite direction, if your economy is growing very fast and you have a problem of demand, you lock your expenditure growth to the potential level, and you do countercyclical fiscal policy or restrictive fiscal policy in upturns. So that works. But at the same time, you need to limit the debt. This is why you combine. You still need a numerical constraint on debt, because you cannot just have a short-term guidance with expenditure rules. So the combination is very useful, and you don't have all the complications, and still you keep the simplicity of transmitting to the population that this is the rule, is more clear and there's understandable than a structural balance rule. Then you say, okay, I am doing my observed deficit is 3%, but my structural deficit is 2%. It's very difficult to understand, very confusing. So this is why we suggest to countries, if they want to do countercyclical fiscal policy and maintain fiscal discipline, for several countries, the option is to do the combination of these two more simple rules rather than a structural balance rule. But as I mentioned before, we have all these type of shocks, and that are not cyclical fluctuations, are not typical situations. And the third generation of fiscal rules call for even more flexibility than structural balance rules or a combination of rules can give you, because you need to attenuate these shocks. You need to have higher expenditures after the natural disaster or the COVID shock. And the idea of this third generation of fiscal rules is to have flexibility to attenuate business fluctuations, and at the same time, more flexibility to specific shocks. And how you get this more flexibility or further space to expand your expenditure when you have a natural disaster is through very well-defined escape clauses. The idea is if you have very well-defined escape clauses with very few I would say, events very well identified that will trigger the use of the fiscal rule. And when you have an escape clause that also not only defines the type of episodes that will trigger their use, when you also define how much you will deviate from the rule when you have this type of shocks, and when you also predefine what will be the period in which you will come back to the rule. These three elements of escape clause: one, the events that trigger the fiscal rule; second, the deviation that you are allowed to have; and third, the period in which you will return to the rule. You have the credibility to do this type of expansions when a natural disaster or a global crisis is happening. This is very important because in several countries have escape clauses, but they misuse the escape clauses. For example, in Latin America, we are specialists in using the escape clause. When we don't like things, we say, okay, it's a crisis. I remember, I am not like Jafar that says, in a country in the world, I will say, for example, Brazil wanted to use the escape clause because the Russian invasion to Ukraine, saying, oh no, this is affecting prices, oil, gasoline, and using this type of fact that I don't see that is too clear. Or also Mexico, they are every single natural disaster that Mexico is a big economy in a small city allows them to trigger the escape clause. So they don't have well definition of the fiscal clause. The other misuse of escape clauses is that if you apply the escape clauses, you have license to kill everybody, meaning that you can expand whatever you want the deficit, and that is also a misuse. You need to define the size of the deviation exactly. And finally, the period. In some countries, they don't have any idea of how many years they will have the escape clause in place. So that are the things that when you design the fiscal rules, you need to be very clear with the escape clause. And finally, I will complete my presentation and with some design aspects that are important in the definition of fiscal rules. And basically, there are, like yesterday in our subsidy framework, we have more or less the same intent of fiscal rules in 6 steps. The first is the legal. Sorry, the first is the legal basis. is the legal basis of the law. That is very important. Normally, we prefer to have the law and the fiscal rule in the constitution or in a higher level law, not in a presidential decree or in a ministerial resolution. You need to have at least the rule in a very high, I would say, level of legal basis. But this also means the following, that perhaps the numerical parameters that you use don't need to be in the Constitution or in the law. You can define in a different legal document, in a regulatory, in a different regulation. You don't need to have. Why? Because if you put everything in the Constitution, you have the problem that when you need to change the parameters, you cannot do, you need the approval of the Congress, etc. So putting the framework in the best practice is to put the framework in the Constitution or in a law, in a budget code, but the numerical constraints you need to put in a lower document, in a ministerial, in a government decree or in a regulation. So that is what you need to do with your, okay. Sorry. The second is how you are able to monitor your rule, and on that, it is very important how you account all the type of things. And one of the problems of fiscal rules is that it generates an incentive to do creative accounting and to put things that below the line. The way is try to I would say try to use different creative operations to justify, to be always observing or complying the law, but in fact you are doing creative accounting, putting some expenditures for SOEs, for example. SOEs is a good way to not to apply the fiscal rules, etc. The third is enforcement mechanism that you need. That is very important, how you enforce, because in several countries, if you don't comply with the rule, doesn't mean nothing. You don't have nothing, nothing in place. So you need to define very clear and strong enforcement mechanisms to punish the policy makers that that don't comply with the rule. The other important mechanism now is the correction mechanism. That is, together with escape clauses, I would say that the difference between the second generation of fiscal rules and the third generation is that both escape clauses and correction mechanisms are very important, and you need to have that. And it's good to have the correction mechanism predefined. Say, okay, if I deviate from my, imagine you have a deficit target of 3%. If I deviate to 4%, this is what I will do the next year. The next year I will froze salaries, I will reduce my investment. Predefine what you will do will improve your credibility. The other thing is the resilience of that your fiscal rule needs to have. In several countries, they put very, very, very stringent limits. And this is with the idea that if you put very ambitious targets, you are more credible. But in fact, when you do that, several times you cannot comply with the law. This happens in several countries when structural expenditure pressures comes. For example, if I have a pension increase because my country is the aging of the population is increasing, and I know that I will need to spend more on pensions. How I can put a limit, a very rigid limit? So many countries, in trying to show that they are credible, they put very, very ambitious targets and they don't comply at the end, and this is something that they need to do. And as I mentioned before, flexibility is the word of very good fiscal rules, because sometimes when you have a very rigid fiscal rule, you don't comply with that and you need to drop the rule in few years. So these two last characteristics, resilience, having parameters that are feasible to achieve, that you know that take into account all the pressures that you have and that give you flexibility, is the way to go. Thank you very much.
Okay. So So let me move on to the last few sections of the presentation. So I'm going to cover two things. I'm going to skip a little bit of the fifth point because we're a little bit behind time, and just speak a little bit about rules in special circumstances. I think most of you are from emerging markets and developing economies here, and so three-quarters of EMDEs are commodity exporting countries, and many of them are resource-rich economies. So these economies tend to have unique problems, and fiscal rules is one way to solve some of the problems they have. I'm not going to go into those problems in this presentation. Fernando will do a presentation on Chile, and Chile is a commodity exporter, so I think he will cover aspects of this. But just to say that the objective of a fiscal rule in this context is really about addressing revenue volatility and uncertainty. Generally, revenue volatility is much higher in these economies relative to advanced economies or commodity importers. The idea of these fiscal rules is to really deliver better fiscal outcomes and to deal with the windfalls or the boom episodes that come from commodity prices and then the ensuing spending splurge. So this is what we refer to as the pro-cyclical policy, right? You get a lot of money and you spend a lot of money. And the other thing they try to really solve is intergenerational equity. And so proposed design characteristics in this case is to define a rule on non-resource terms, so on a non-resource balance or on a cyclically adjusted balance. The idea here also is to save your windfalls into a sovereign wealth fund. So this is really where you pair a fiscal rule with a sovereign wealth fund, and you create clear rules on contribution and withdrawal from that sovereign wealth fund. But let me leave the rest to Fernando and move rather to a paper that I'm working on with two colleagues at the World Bank, Charles Juste and Sebastian Miller. And this is a paper that we're working on that is under the KDIS trust fund that we manage. So this is work in progress, and I kind of want to talk a little bit. This project is really about the commitment to fiscal rules. The objective here is really to quantify commitment or compliance to fiscal rules using an estimate of an expenditure reaction function. If you don't know what an expenditure reaction function is, don't worry about it, I'll get into it. But all I want to say is our objective is to do two things. One, in this paper, is to assess the current compliance of fiscal rules. So we're trying to answer questions like, is spending too high? Is spending aligned to your fiscal targets, right? If you have a fiscal rule, is it aligned to those targets? And then the other objective is really to create scenarios around which you can meet your target. So thinking about where you are currently and what you're doing currently in terms of your fiscal rule to where you want to go to be able to actually meet your target. And here I'm going to talk a little bit about, is spending too persistent and how aggressive should you be changing spending to be able to reach your target outcomes. Of course, there's a lot of literature already on compliance, and what does that literature kind of say? Well, there seems to be a mixed and uneven performance in terms of countries' commitment or achieving their fiscal rules. So this is from a recent paper by the IMF, and you can see on the left chart we're talking about compliance to budget balance rules, and on the right, compliance to debt rules. And the basic message here is there are lots of countries that are not complying with their fiscal rules, with their targets. In emerging markets, you can see 2022 to 2024, only about 1 in 2 countries are actually complying to their targets. In the case of debt rules, again, you can see it's about 50% in EMDEs. What this also should show you, this chart show you, is things get complicated when you try to assess a country's commitment or compliance to fiscal rules, because there's lots of things that are happening, right? There's the temporary suspension. We spoke about the escape clauses. This complicates how we assess whether a country is meeting its fiscal rule. So to do this exercise, to estimate this expenditure reaction function, we're going to take an IMF fiscal rules database, and we're going to manually add all the numeric targets for debt and budget balances that countries have. And then we're going to look at total expenditure, its debt, and its budget balance, and try to understand exactly how do countries deviate from their targets. And so I want to give you just a general perspective of this. So if you took on average all countries in this database, so that's about 106 economies, both advanced economies and EMDEs, and you plotted average debt levels and average debt targets across these countries since they implemented fiscal rules, what you can see is that on average, debt was below their targets, but there was this bias or tendency to breach the target over time. The other thing you can see is that the gap between the target and actual debt outcomes isn't actually that large. Debt is actually pretty close to its target outcomes. But of course, we're averaging over a lot of economies, so this is a biased picture in some way too, right? Because it could be a country has a different target to what their debt is, but it is very informative to tell us what's actually happening in these countries that adopt fiscal rules. The other side of this is the budget balance. So in countries that have a budget balance target, what is the outcome for their budget balance since they introduced the rule, right? So T+1 to T+20 is the years through which they've introduced the rule. And what you can see on average in the data set again is that budget balances are much larger, or budget deficits are much larger than actual target outcomes. So, and that's true basically throughout the sample period we have in this case. I think there's 2 years where they're actually not, they're actually at their target or slightly above their target on average, again, of course. But it's probably better to look at this in a gap term, right? We want to take a country and we want to take its budget balance or its debt and we want to compare it to its target. And if you do that exercise, so over across, I think this is about 75 economies that we have in this case, what you can see on the left chart is this gap between debt, the debt target, and the actual outcomes. So in advanced economies, on average, debt is above its target, although there's a big variation, right? There's countries that have debt well above their targets and countries that have debt well below their targets, somewhere in the range of, let's say, at the 25th percentile, you're talking about 20% of GDP below your target, right? 60 to 40, for example. Whereas in emerging markets, on average, they tend to have debt below their targets. And if you look on the chart on the right, you get a sense of what it looks like across the regions that the World Bank focuses on, right? The emerging market regions. So in LAC, Fernando gave it away, but basically on average, they're running debt well above their targets. Whereas in sub-Saharan Africa, the opposite is true. They tend to, on average, run debt below their targets. So those with targets tend to, on average, run it below. This is average over the entire period. If we look at the budget balance now, we see on average that advanced economies on that left chart are pretty much at their target on average. Again, there's quite a lot of variation. But then for emerging markets and developing economies, because their debt level is below their target, on average they tend to run larger deficits than their target is. And again, on that right chart, you can see this across the different regions. So if you're in South Asia, for example, you tend to have budget deficits that are quite large relative to your targets, whereas in East Asia and the Pacific, slightly more prudent outcomes, deficits tend to be, or surpluses, tend to be above or below, in this case, their target. So you promised the only equation in my presentation. So basically what we're going to do is we're going to then take this and we're going to try to estimate an expenditure reaction function. And all this is going to tell us is how have governments in the past adjusted spending in response to debt and deficits from their targets, right? So G here is the government spending to GDP. There is some persistence in that spending, right? I think we yesterday heard a little bit about rigidity in spending. That's a big problem in emerging markets and developing economies. So there's some persistence in spending, and then countries are going to, we're going to try to uncover these sort of policy parameters, right? These policy preferences of how a country adjusts spending to respond to debt from its target. So that's the previous quarter's debt from its target and the budget balance from its target. And from this estimation, okay, let me actually first talk. So this is the expenditure reaction function. And let me give you an example of how this actually plays out in sort of what this means. And the one way to do that is to look at this persistence, that beta parameter, and to really look at the problem of rigid spending. So what we're going to do here is we're going to take a country that's coming out of COVID. And we're going to say that country's running expenditure at about 25% of GDP. It's got a pretty large deficit, 7% of GDP. And its sort of revenue level is about 20% of GDP, right? It's running a deficit, so revenues is below expenditure. And that revenue level will also give us some sense of sort of like an equilibrium spending level. Not entirely, but just go with it. And then we have nominal growth at about 5% and an interest rate at about 3%. And so we're going to take this expenditure reaction function. We're going to add two other equations, one on sort of debt behavior and the deficit behavior. And we're going to look at different scenarios of how this country would adjust spending given if it has rigid spending or if it has less rigid spending. So this chart on the left gives you government spending outcomes. You can see that orange line, when there's high persistence, spending tends to come down slowly. And of course, you're going to see the corollary of that with the budget balance. You're going to see the adjustment that does not come as a consequence. Of course, if you were a country that had low persistence or less rigid spending, you can adjust quite quickly if you need to bring your debt back to its target. And so these two charts then give you the perspective of what that means for your debt outcomes and your deficit outcomes if you are running, for example, rigid spending. And this is pretty common in emerging markets. You know, you get this ratchet effect in spending, which means as spending adjusts up, it never kind of adjusts back down. And so you can see again in the high persistence case, debt never goes back to its target, and the deficit takes very long to get back to its target. Whereas in the low persistence case, a country is able to adjust to that target. So from this estimate that we're going to do, so I'm going to skip how we do it and all the details around that, but just trust me that it's good. We could at some point argue against that. We're going to generate two indicators, and I'm only going to, for time again, focus on the first indicator. So this is an indicator to tell us about the commitment to its fiscal rule, and we're going to call this basically expenditure required. So the idea is here to test whether the government's size is consistent with its stated targets. And I'm going to skip some of the details here as well and just say that there's going to be a gap between what a country is actually spending or what we estimate they're going to be spending from their expenditure reaction function and the actual spending required to get back to the target. And so if we plot this gap between the two measures, this is the histogram of that. So countries on the right of that chart, on the right of that chart are on average spending too much and hence are not reaching their target outcomes. Whereas countries on the left are on average spending below what is required and are actually reaching their targets. So if we were to break down this gap between advanced economies and emerging markets, what you can see is on average, emerging markets are spending too high. This is a view of their past performance. And on average, this is happening more in commodity exporters than in commodity importers. This is the other indicator, which I'll skip for now. The last thing I want to do is that I told you we had two objectives. The one was commitment. The last one was actually some scenario work. So now we have an estimate of a country's performance, right? So in this case, we want to look at those countries that are currently above their debt targets. So what we're going to do is we're going to estimate a pooled reaction function for these countries, and we're going to look at what the estimates are of their policy preferences, right? How much are they going to react to debt from its target and the budget balance from its target? And sadly, the story is countries don't react to debt from their targets on average in this estimation. And we're going to take these countries that have debt above their target, On average, they have debt at about 80% of GDP, but on average, their target is 60% of GDP. On average, these countries are growing at about 5% nominal growth, with an average effective interest rate of about 3.3% of 3.3%. And finally, average spending in these economies is about 42%. And the basic story here is that the status quo is not workable in these economies. That the baseline status quo line, which is the blue line here, shows you that if these countries do what they did in the past, what they did on average in the past, debt is not going back to their targets. Debt is rising over time. However, if they were to become more aggressive to respond to that debt and actually do the adjustment, and now in this types of scenario work, you can look at, well, how long will they take to adjust, what kind of adjustments they can do. You can see that on average, they come back to their debt targets and below their debt targets. And these are the sort of outcomes on the budget balance and government spending. And that chart on the left, I just want to show you that if you were to aggressively respond to debt, it really requires these countries to run surpluses on average for 5 to 7 years. And that kind of surplus will help them bring debt back to their targets. So let me conclude the whole presentation. So we saw that fiscal rules are numerical limits on key fiscal variables, and that their objective is, although they never, empirically we don't always know that's true or not, or it's contested, they attempt to solve a deficit bias, promote fiscal discipline, and lower borrowing costs. We've seen how these rules have evolved over time, given the challenges faced by countries, and we've seen how the commitment to these fiscal rules have been mixed and uneven across countries. And finally, in the work that we try to do is we're really trying to propose new indicators to think about this credibility or commitment to fiscal rules. Thank you.
Okay, thank you very much. We have like 20 minutes, so do you want to interact with them directly or? Like Anders did yesterday, do you want to interact with them or? All right, then. Okay, so thank you very much again for the informative and insightful presentation. So in Korea, there's a saying that if you tie it, then you untie it. Right? So I'd like to put these two experts in the driver's seat, and you can interact with them directly. So thank you.
Yeah, we have the first question in the first line.
Thank you. Wonyak Lim from KDI School. I have a question for Fernando on the difference between monetary policy and fiscal policy, and one question for France on some assumptions behind empirical work. You started out your presentation, Fernando, by talking about timing consistency. Now, in monetary policy, as you mentioned, there's inflation targeting, Taylor rule, as well as increased central bank independence, which I think was crucial in driving this outcome. But in fiscal policy, I don't know whether we can replicate the kind of central bank independence in fiscal areas, because in most countries, it's the parliament as representatives of voters who make major decisions on fiscal policy. So I don't know whether there's an equivalent central bank independence you can create in fiscal areas. And related to that is that because in monetary policy you have increased central bank independence, you are able to use, relatively simple inflation targeting, Taylor rule, and so on. But in fiscal policy, as you alluded to, if we are going to avoid timing consistency problem, you have to have fairly binding rules, right? In practical terms, then are you saying we need to have like a constitutional provision on target debt ratio, budget balance ratio, and so on? And because that seems rather odd. It'll be very odd to put like 60% debt ratio, 3% budget deficit ratio in the Constitution. But if you do not do that and actually delegate these target ratios to lower level laws, then time inconsistency problem can happen just as easily as before. So what is the practical solution to that? And you mentioned at the end of your presentation the credibility of stringency, and in fiscal areas especially, I think that's an important thing to consider. So that's my question to you. For France, in empirical results, you talked about the gap between target and actual ratios, right? How are countries without target debt ratio or budget balance ratio treated? And if you somehow excluded these countries without fiscal rules, isn't there some selection bias we have to worry about? That's it. And in the last part of your scenario work, is interest rate fixed at like 3.3%? There's no interaction between rising debt ratio and interest rate? And what is your assumption on the composition of nominal growth? Because you could use inflation to reduce debt ratio as advanced industrial countries had done in the wake of World War II. So yeah, those are the questions.
Thank you. Don't know if we have another question, and then we will. Okay. Yeah. Okay.
Okay, thank you so much for presentation. I just want to maybe ask something on Japan. Yesterday I was doing a presentation in class at KDI on Japan's economic development narrative, and I was looking at the both fiscal and monetary policies that has helped Japan to grow. And some of them you have talked about in your presentation. You talked about the balanced budget rules. You talked about the debt rules, both the fiscal and the monetary policies, and even the combined policy mix. All of those Japan employed during the economic growth. But what is really coming up now is, despite all those policies that Japan has used to maintain a stable economic growth, the debt rate is still very high for Japan. They have been using quantitative easing for quite a very long time, but as at now, the debt rate is up to 240%. So Professor Randall was asking me, what should Japan do to reduce the debt rate? Because the economic growth is actually one of the best in the OECD countries, but the debt is escalating each and every day. So maybe I can get an answer from you. What should Japan actually do? Thank you.
Any other questions? Okay, 3 questions because I will forget the others. And
Good morning. Again, thank you so much for the insightful presentations. It's very enlightening in so many ways, but I have 2 questions. The first one is, in all of these fiscal rules and its frameworks, I wonder if it's all based on debt for productivity, or it was also accounts for debt for consumptions, and is there any different thresholds for debt for consumptions or debt for productivity in regards to having a debt sustainability in your presentations. And then the second one is also there are many circumstances affecting the fiscal rules that we are making. So I wonder what is the ideal time frame to have a review of the fiscal rule we already have, given that also in some countries, different governments or presidency might have different political influence to the fiscal rules. So I wonder what is the ideal periods of time to create fiscal rules that are sustainable and still feasible for review. Thank you.
Very good. I can start with, well, very difficult answers. All are very tough. The three questions very, very tough, and I'm happy to try to answer because I think that there is a debate. On the question of, on the first question, that is a debate that is not solved because during several years, I do fiscal policy basically. I was not convinced with the idea that we need to follow monetary policy things. And still this debate is very clear. You took the point, differently from monetary policy. Fiscal policy involves political decisions, politicians, voters' interests, while monetary policy can be more technical. You have the define, you have the Taylor rule, no brain you can do. If you reinforce the independence of the central bank, you are protected. But now in other countries that I live, you see, even this basic agreement of monetary policy is put in that. So the influence is also on monetary policy, but monetary policy was more able than fiscal policy to resist the pressure of the political system. That is, that is true. But what fiscal rules can do in dealing, the ideal, for me, the ideal role of fiscal rules in relation with with politics is that when fiscal rule, you put the size of the field, you define that, and politicians can still do the allocation. For me, the discussion in a society is, okay, you have this size of budget. Now, the politicians need to discuss, okay, I prefer education, I prefer defense, but with a common understanding that they have a limit. This is what fiscal rules put. Several times in Latin America, essentially, the discussion on having or not fiscal rules, the politician says, you technocrats are stalling my, my role of deciding where the budget needs to go. We don't want to stall it, but we can put at least the limit, say, okay, if the society and the voters prefer to expand infrastructure instead of education, good. This is the true political function of a parliament, to do that type of choices, but not to define things that are above the above the resources that the government has. So I think that I recognize we cannot just mimic what monetary policy does. The context is different, but at least creating a rule-based thing gives you, for me, the right scenario to discuss policy priorities in a country. When you don't have a constraint, a basic constraint, you don't need to have any choice because you are not constrained. The politician, they don't have, it's just to say, okay, I need to increase health, I need to increase education, I need to increase defense. And the idea is to put some restrictions to that discussion. And I think that when you have this discussion, it's very important to having the limit, and politicians can allocate as they want. That is their role. They were voted, is the right, basically, what they do. But they cannot do just say, okay, I need to increase without limit. This is something that I think that is still recognizing that you are right, we cannot mimic what monetary policy did or is doing, but I think that at least putting more rational to the discussion of budget allocation is what a fiscal rule can do. Other role that, other function or other role of fiscal rule that I have also, I am not too convinced of that rule, that the fiscal rules in some cases help to promote reforms. I will cite the country that I live most of my life in, Brazil. They decided to do the following. One of the fiscal rules was expenditure rule, very stringent expenditure rule, zero growth, because they believe that the state is too big, it's more than 40%, and with a zero growth rule of expenditures, over time, this will reduce. But was too stringent, the rule. Most having, I think that Korea has the same problem, pension pressures, because aging. So the people that did the fiscal rule in Brazil say, I told with them, why you put zero if you have a deficit of the social security system of 4 or 5% and increasing over time? And they told me exactly because with the rule, we will force the politicians to do the pension reform. They were very wrong. At the end, the rule in 2 years was abandoned, and politicians still, the pension system was not reformed. Perhaps they were too idealistic, no, or naive, but they believe that with the rule, you can promote reforms, and I think that is not clear for me. Japan?
Yeah, can we go to Japan?
No, if you don't have.
Let me not go to Japan first. Let me just quickly go to the gap between target and so your first part of the question was about whether we have a selection bias or not. In essence, we don't, in the sense that all we're after is estimating an expenditure reaction function, the policy preferences of countries that have targets, and then comparing countries who have targets to who have targets. So across, let's say, emerging markets versus advanced economies, commodity importers, commodity exporters. If our question was about whether fiscal rules do something, on fiscal variables or so on, then I guess we would care about the selection bias. But here, we're really just interested in policy preferences, estimating those, and showing the differences across all countries in the realm of those with fiscal rules. In terms of the scenarios, yes, we built in some feedback from debt to the interest rate. The way I did it, I mean, you could do it lots of ways, but all I did was I said debt deviations from its target would raise interest rates by whatever percent, and I think I went with about 2 or 3 basis points for every additional increase in debt, and that's pretty much well aligned to the literature. Although, I mean, anybody could say whether there's some nonlinearity in that. I didn't build in that nonlinearity, but there is some feedback from debt to interest rates and from spending to growth, just to make those scenarios a little more realistic. In terms of Japan, I'm not going to answer. As the student, I guess it's up to you to go and find your answer. Let me not make your life easy in the interest of time. Sorry if that's not exactly the response you wanted. And then the question on debt for productivity and debt for consumption, I guess you're asking whether it's investment or current consumption. The solution in the fiscal rule setting is coming up with a golden rule. Someone like a country like Morocco, for example, I don't know if it's still true, but I believe it's still true, only borrows money, so only takes out debt for investment, not for current spending. Of course, things get always a bit complicated with things like golden rules, is how do you define investment? Sometimes creative accounting comes in and so on. And then ideal time frame for a fiscal rule. Do you want to take that?
Yes. This is other thing that is still there is debate. One thing is that you need a stable rule and a stable framework. You cannot change every single year of rule. There are countries that they are always or preparing a new rule or criticizing the rule that they have, and this creates a lot, exactly the opposite effect of a fiscal rule that wants to do predictability. So revisions are accepted because you are living in a world that is changing every single day, and you need some flexibility to that. But you cannot do fiscal adopt and readopt and reform rules every single year. You need some stability on rules. What the compromise for me is still, and I think that also related to the questions that you had, is on the numerical parameters. Of course, if you have numerical parameters that can change, also is a way to violate the fiscal rule and to not have flexibility. But putting the numerical values in a constitution is too rigid. That generates a lot of problems. And I will present in the next session the case of Chile. The government at the beginning of their term, when a new government is elected, in 90 days they need to define the structural balance rule targets for its 4-period term. And then, and this is the lack of, this is I would say the maximum flexibility that you have is the decision of the government, but for 4 years they decide what will be the target. So, but changing rule every year is not a good practice. Complementing and endorsing the answer of my colleague, I am of the old economists that believe that one objective with one policy instrument, that one policy instrument cannot resolve several policy objectives. Fiscal rules are not intended to improve productivity. Fiscal rules are not also intended to promote income distribution or to do this type of thing. Fiscal rules is a simple tool to ensure fiscal sustainability and to generate credible fiscal policy. I don't believe that on all these multiple roles, and that's one of the problems. There is a last round of questions, because I think we are going.
Yeah, thank you for your presentation. So actually, I'm the supporter for the fiscal rule, but these days it's quite hard to support the fiscal rule, and these days we are facing several fiscal challenge, and this fiscal challenge is quite persistent and long-term challenge. For example, you mentioned about the pension reform. So one of the pension reform scenario is the changing from the pay-go to the funded system. And as you know, the many Latin America and the Eastern EU country transition from try to provide set up some funding system, but as you know, in that case, there's just some kind of fiscal injection in short term. But we have a strong fiscal rule in the EU country and other fiscal rule implemented country. This fiscal rule actually prevent some kind of the pension reform scenario. It's kind of restriction for the short term, even though it bring out the long-term positive effect. But the fiscal rule caring about the mid-term to short-term selling or the limit. So, do you have any comment or future generation of the fiscal rule to prevent that kind of the objection from the other side?
Okay, so due to the time limit, so I mean, this is gonna be the last question.
Thank you. Just from KDI School, just a quick question. I was just wondering, when you were going through the expenditure reaction function, the 3 rules that you talked through, hybrid, debt, and budget balance, like we're talking about fiscal flexibility and fiscal discipline. So in terms of these 3 rules, how does it influence both fiscal flexibility and discipline when it comes to shocks like what we had during COVID-19? Thank you.
Okay, I mean, due to the time limits, these 2 questions will be
Okay.
the last
Okay.
ones.
Yes. On the pension, this is a very interesting debate. As I mentioned it before, in Brazil they wanted to put the horse behind above the car, saying, okay, the fiscal rules will promote the reform. And my suggestion is exactly the opposite. You need first to do your fiscal reform, your pension reform, and then see what will be the effects of that, and put your fiscal rules on after that, not before. And I think that this is also valid for Korea. If you will do your first, I would say it's better to do the pension reform, and then you can do the fiscal rule, because you will have this new parameter. But one of the issues that I was thinking yesterday in the case, because I read the presentations, and one of the main challenges to fiscal ruling in Korea is the pension reform and the pension system and the effects and certainties that this will generate. And it's very clear that if you go from a pay-as-you-go system to a fully funded system, you will have an increase in expenditures or a reduction on revenues, because the new contributors will not finance the pensions of the current retirees. They will finance their own pensions. So you will have a lot of expenditures and a big liability without revenue, because the revenue will be of the new entrants will go to their own accounts and the fully system. So this type of reform, when you go from as pay as you go to a fully funded, generates a temporary big deficit in the public account, a big deficit. In some cases, the deficit is so high that it's impossible to do the reform from as pay as you go to fully funded system. And perhaps one of the solutions that I was thinking is to have, in this case, a structural balance rules, because between the fiscal rules that are corrected by economic cycle, you have the cyclical adjustment balance rules, the CAP, what we call that, and the structural balance rules. What is the difference between one and the other? The structural balance rules can accommodate once for all expenditures that you will have. Differently, the cyclical adjustment rule is only economic cycle, GDP cycles, and that's it. The structural balance rules, on top of the cyclically balance adjusted part that you have, or if you have commodity prices, also you accommodate this type of shock. Also for extraordinary type of event, like a pension reform, or you can have the opposite, a privatization of assets that gives you additional revenue. You need to take into account and filter this extraordinary or temporary expenditure that you will have, excess of deficit. And you can have, I think that if Korea wants to enter in a structural balance rules, could accommodate the expenditures that you will have, the excessive expenditure that you will have with the pension reform. It will be a way. But putting the 3% deficit and the 60% deficit without doing the reform, really, being very honest, is not the way to go.
So related to the expenditure reaction function and shocks like COVID-19, I guess there isn't an easy way to think about shocks in the context of an expenditure reaction function. I mean, from a technical perspective, you probably want to exclude, when you're estimating these kind of things, periods when countries use escape clauses and so on because of these shocks. But I think your question is more really about policy and fiscal rule design. And that really goes back to some of the things Fernando said in the presentation on third generation rules. I encourage you to go read. The IMF has released quite a few papers recently on fiscal rules and their design choices and thinking through, I guess, these third generation type fiscal rules and how you address these big shocks. And I'm happy to discuss it more on the break.
Okay, this concludes session 4 of this conference. So again, I'd like to thank these two experts about these nice presentations. And you can have some time to talk with these experts through, the break time or through lunchtime, so you can ask them more questions. And I hope you enjoy the rest of the conference. Thank you very much.
So we will now take a short break from now on. As Professor Lee mentioned, please free to come up to the stage to talk with the presenters. And the next session will begin at 10:45. Ladies and gentlemen, we will now begin session 5, Reform of Fiscal Rules in Practice. And this session will present a comparative discussion on fiscal rules across India and Chile, highlighting their design, implementation, and trade-offs in different contexts. May I now introduce our session moderator, Dr. Jin Park, professor at the KDI School of Public Policy and Management. And joining him are our speakers, Dr. Vincent Paul Belinga and Mr. Tanvir Malik, who are joining us virtually, and Dr. Fernando Blanca Cosillo, along with our discussant, Dr. Chung-Eun Lee. And Dr. Park, the floor is now yours.
Thank you. Okay, I hope you are enjoying your time here. And session 4 wonderfully laid a foundation for this session. And now through the 2 country study, we try to see how other countries are conducting a reform of fiscal rules. There are 2 papers will be presented. One is on India, the other one is in Chile. Normally, when we have a country study, there are things that we expect. The first, description on the status quo, and of course, why each country selected that rule, and what is temporary assessment. Okay? The second will be evaluation of the whole system. So what affected the effectiveness? That will be very interesting, the second topic. And of course, finally, the lessons for other country, including do's and don'ts for the fiscal rules. And regarding the description, as we have found in this first morning session, there are things that we are interested in. The first, the coverage of the fiscal rule. Does it cover the central government only, or the local government, or even government affiliated organizations? Or does it even cover social insurance fund? Okay, that's a coverage issue. Second is threshold indicator, like a deficit or the debt or an expenditure. There are different threshold indicators. Of course, it should come with the target horizon. Okay, does it follow rolling window system or annual system? And the next interesting description will be the exceptions or escape clauses. Okay, it shouldn't be too tight, or it shouldn't be too flexible. Number 3, legal foundation. Is it constitution or the statutory rule or administrative order or even just a guideline? And how is it enforced? If there is the breaches of the rule, what will be the sanctions? What will be the corrective procedures? Number 4, it will be the monitoring and the enforcement process, including supervising authority. Who is in charge of the whole process? Who will be responsible? The player issue, also very important. And I am sure that the presenters are ready to answer these questions, but if you are not, please try to add this information in your presentation.
I will present in this session the case, what we call the poster boy of Latin America in terms of fiscal rules, and I think that not only Latin America but in other contexts, Chile is a good example of a well-managed fiscal rule. And with other instruments that they use, and they have a very, very good fiscal position and very comfortable. But in the last years, it changes significantly, and we will see not only the good aspects, but also the challenges that they face. So my presentation includes first an overview of the Chile fiscal framework. We will explain in detail how the structural balance rule works, the challenges that the countries suffered in recent years with the rule, recent reforms that were approved in 2024, and the role of the Fiscal Council on that, and finally, the lessons of the Chilean experience. Basically, Chile has, as I mentioned before, a very solid institutional fiscal framework that is very well recognized because it's a strength, it's very credible, and also in terms of transparency. As I mentioned before, the pillar of the fiscal framework is the structural balance rules. That, as discussed in the previous session, gives you the opportunity and the flexibility to correct or to attenuate economic cycles. Chile has not only the GDP cycles, but also as it is an exporter of copper, the copper price fluctuations also affect revenue. So they try to attenuate the shocks on these two variables. And also the framework includes a well fund. That is exactly to manage the commodity windfalls and support the fiscal rule. In Chile, they have also a very now independent autonomous fiscal council that oversees, that monitors the compliance of the rule and enhance transparency. And finally, as I mentioned before, this allows Chile to keep debt levels under control, exert stabilization policies with countercyclical fiscal stance, and also the way they manage the well fund is an example for other countries that are resource rich and have. But in any case, what I want to emphasize in the presentation, and perhaps the main message, is that even this strong framework needs to be reformed continuously because there are new challenges and you need to adapt your rule even if you are doing well. And basically here is a context, a historical context of Chile fiscal framework. The framework will have 25 years already, and started with the adoption of a balance rule, basically of a structural balance rules in 2001. And that was only included in a law in 2006, after 5 years of trying to, I would say, pilot the fiscal rule that they have. They institutionalized it in the fiscal responsibility law, and at the same time, they created the sovereign wealth fund. In 2013, they created an advisory fiscal council that was perhaps the weakest part of the framework, and that was reformed in 2019, creating the autonomous fiscal council. The difference between one and the other is that the autonomous is fully independent. The other was dependent on the Ministry of Finance, and they did a strong reform to provide independence to this fiscal council. And in 22, they added to the structural balance rule a new rule, a debt rule that was not included, and I will explain what was the rationale for why they decided to include another fiscal indicator, having now what they have a dual fiscal rule. They have also, in 2024, included a escape clause. They didn't have escape clause, and also included an automatic correction mechanism. So what I want to show here is that everything evolves, and you need to do that evolution according to the changing circumstances. And here a snapshot on how the fiscal rules work, how the structural balance rule work in Chile. The first thing is that they know, and it's very clear, that tax revenues are very fluctuating in Chile. Are fluctuating because you have economic activity fluctuations, but also because they have this copper, the revenue from the exports of copper. So they have a very volatile and procyclical revenue. This is the challenge that Chile wants to address. When you have these procyclical revenues, the tendency is to have also your expenditure very procyclical. If you adopt a simple rule or a balance rule, what you will have will be also procyclicality on the expending side. The way to attenuate or reduce these procyclical revenues is to have a structural fiscal rule. So what they do is to adjust revenues by the cycle, as I mentioned before. Or you can have the non-mining GDP growth trend. They exclude the part that depends on the mining, and they correct they separate cycle and trend of the non-mining GDP, and they do the same with the copper price. In the copper price, the adjustment is different than the trend in the GDP. In the case of the copper price, what they have is a calculation of the historical price of copper. When prices are above this historical level, they accumulate reserves in the wealth fund. When the prices are below the historical prices, the wealth fund injects resources in the public, in the government, and the government can do the procyclical fiscal policy. So this is the way in which they manage this volatility of revenues. And one of the important things is that both the calculation of the GDP of the GDP fluctuations and the copper price are independent, and that was important because if the government will do these calculations, they can manipulate the thing, no? And they say we need independence on that because the government always has an optimist bias, saying, okay, no, this is not the price. This is why they decided to have independent assessment of the structural revenues that they have. With this cap that they have, they calculate what is the critical variable here, the structural revenue. Revenues that are filtered by economic fluctuations and by the price of copper volatility. So with this structural revenue, they define the structural balance in a way in which they have, it's just the difference between the structural revenue and the expenditures that they have. As they have the target on the balance, what they have is the fiscal space for spending, and this is the other critical variable. This is the cap on expenditure that they have. They say up to here is our role to put this expenditure cap. From this onward are the politicians who decide how to allocate this fiscal space for spending. They have different options, etc. And of course, all this system is supported by the well fund. The well fund is the buffer. As I mentioned before, when copper prices are above the historical levels and GDP is they are in a positive upturn, the well fund accumulates resources to be spent when they have the opposite situation. So the system seems to be working very well on that side. So as I mentioned before, the basic metrics that we have here is the actual fiscal balances is the normal, the observed revenues minus the total spending. So they have the actual. The structural, as I mentioned before, is just the difference between revenues. Only revenues are corrected by the price and by the GDP cycle, and expenditures is what they have. And then they have the structural fiscal balance. And to calculate this fiscal space, the fiscal space for spending, they do just define here the structural fiscal targets that they have, and I will explain how they define that, minus the structural revenue, they have this fiscal space that is what they have, the availability of resources, if you want to call in a way. But this availability is already filtered by economic fluctuations. So basically, how this works in practical. What it works is that at the beginning of each administration, in 90 days, the new administration needs to propose to Congress the target for the 4 years of the structural balance rule. They say, okay, we will have a structural balance rules of 0, 2, 3, or 4%, and they need to follow that. This is what is not in the Constitution. This is a decree of the government at the beginning of the administration that they cannot change for the 4 years. And then they define how they do the budget. With this definition of the deficit for each year, they calculate exactly what I mentioned before. The structural, the target and the structural revenues define how much will be the expenditure cap for each year. And as I mentioned later, the money that is that goes, the revenues that are in excess of the structural revenues go to the well fund. When the revenues are lower than the structural revenue, they do the opposite. They withdraw money from the well fund to finance the government. So that is a very simple way in which they work. Now the question is, what, if everything is perfect, what happened and why they needed to reform? And here, I would say that they have two big shocks that were not cyclical fluctuations, basically. The first shock was before COVID. They had this social unrest that they have almost a revolution in Chile in 2019, and the demand was for more social spending. So the government decided to, as part of the negotiations, to say, okay, that we need to alter our system if we want to enable to increase expenditures in the way that the society was demanding to increase. This was a very, very significant shock. It was almost a month that was a social unrest that was very, very violent, and then which called for some exceptions to the fiscal rule that they didn't believe that they needed. And the second was the COVID period. How we see the and on top of these extraordinary shocks, after almost 20 years of working of the rule, they noted that the debt was increasing a bit. There was a tendency to increase the debt, you see, even having the rule. And the well fund was in a declining, the volume of the well fund, it was in a decline. Here, as you see, here is exactly the two shocks, the COVID and the social unrest shock that they have. So this call for a reform on the deficit. What type of reforms they implement? The first was something that I mentioned in the previous presentation, that even if you have a structural balance rules that give you the flexibility to attenuate shocks, there are shocks that are not part of the cycle, are not part. And this suggested that they needed to have a escape clause. For a while, when I was talking with policymakers in Chile, they said, with the structural balance rules, we don't need escape clauses because the rule gives us this flexibility. But they didn't differentiate that there are shocks that are cyclical or price shocks and GDP shocks or GDP fluctuation from other type of shocks, idiosyncratic shocks that the rule was unable to accommodate. So this is why they created the escape clause. They included to the rule the escape clause. They didn't want, during 20 years, they say, we don't need escape clause. Our system gives us, the structural balance rule gives us all the flexibility that we need to attenuate shocks, but that was not the case in these extraordinary shocks. And the second was the accumulation of debt. From having Chile up to 2010, a negative net debt because what they had in the wealth fund was higher than the debt began to increase, and the structural balance and the wealth fund was disaccumulating resources. So they said, okay, everything is working well, but we don't know why the debt is growing. If we have a structural balance rules, it will be neutral in terms of debt, but the debt was increasing. And there are two problems with that. One is that perhaps they have technical problems to calculate how much is the structural balance rules. And this is why I'm saying even very sophisticated countries like Chile have difficulties to calculate that. And second is that, for me, was the missing point. They needed a combination of rules. They needed a debt rule just to signal to the market that when debt levels reaches certain levels, the countercyclical fiscal policy needs to be put in a place, and you need to ensure fiscal sustainability. And that is what they did in the reform. If you see the reform to the previous system are the things that are in red. The first thing that they did include a escape clause. But as Chileans are very serious, they did a escape clause that is very, very well defined, specific shocks. The fiscal council needs to approve if there is if the exceptional conditions are there. The second thing, they also decided to have a correction mechanism, pre-announced to everybody that when they deviate, what they will do, exactly what they will do, they define. And they defined a debt target of 45% of GDP as the second fiscal rule on debt. They say, okay, we will not allow the debt going to increase so much, even if we have the structural balance rules. Countercyclical fiscal policy has a limit. If you are a high debt country, you cannot be countercyclical. This is a luxury for countries that have good, low levels of debt, and they recognize that and they put a limit that. And this is the other debate. Why they decided the 45 when they could put the 60 that everybody has? Because they say our country have different circumstances. We don't have access to full access to markets like other advanced countries, even if we are the most advanced countries in LAC. So that is one of the things that was very very important, to put a limit, that a debt limit that that is related and consistent with your ability to access markets. And on top of that, what they did at the end was to say, okay, our fiscal targets for the structural balance were too high. So they decided, the last administration that took power in 2022, put very, very lower structural balance rules targets. And the idea is to get a structural balance of 0 by 2027. 27 is what this is. And they have this declining targets for the 4 years of this administration that ends next year. So I need 3 minutes more. The other good improvement that they did was on the institutional dimension. As I mentioned before, the current autonomous fiscal council was an upgrade of the previous advisory fiscal council that they had. The advisory fiscal council that they had up to 2019 was only an advisory body. They needed to advise the Minister of Finance on things, but they didn't have any independent opinion. The only thing was to advise, and it was placed within the Ministry of Finance. In 2019, they recognized that they needed to improve that to make it more independent. What triggered this reform was that the president in 2014 or 15 decided to fire the president of the Fiscal Council because he was not happy with the with the advisory role of him, and he simply decided to fire. And this generated a reaction of the society, saying, no, this needs to be independent. It's not the president that if he doesn't like the opinion of the Fiscal Council, he will fire. We cannot allow that. So they created the independence of the autonomous fiscal balance that has all these categories. The first mandate is fixed term for the members of the Fiscal Council. The second thing, of course, the directors cannot be removed by the government unless something very, very serious happening. And also they have budgetary autonomy. That is very important for a fiscal council, because if the budget depends on the government, they can say, okay, I don't like your opinions, I will cut your budget. That is not possible in the structure of Chile. So here are the differences between the two fiscal councils that they have. The new one is really good, is up to all the things. And the last slide is on the lessons, no? As I mentioned before, Chile is the poster kid on fiscal management, I would say, across the world. But still needs to, but we need to recognize that what they have was the result of an evolution. Trying to address the challenges that they have, make the system much more consistent, much robust in terms. As I mentioned before, the structural balance rules gives you flexibility to counter-cyclical fiscal responses, but you need, in this world of idiosyncratic big shocks, you need more flexibility. This is provided by the escape clause. The third is that, anyways, even if you have only a structural balance rule target, if your debt is growing, even being Chilean, being very credible, you need to establish another rule, a debt rule, to signal the market that you will not, that you will stop your counter-cyclical fiscal response if that level doesn't allow to do. And that was an important message. And the other thing is, the other two aspects, as I mentioned before, having an automatic correction mechanism and pre-announce this correction mechanism improves your credibility, the predictability of your fiscal policy, and also signals the market that when the government will face a difficult fiscal situation, he will react to that. And finally, as I mentioned before, the transformation of the Fiscal Council in Chile from advisory role to a more independent role was a very good strengthening, institutional strengthening. I will stop here. Thank you.
Thank you very much. Thank you. Thank you, Dr. Cosillo. So you have been very busy this morning. Presenters in 2 sessions in a row. Thank you very much for your efforts and the service for us. Professor Lee Jung-hyun, it's time for your discussion. Flexible 10 minutes. Yes, please.
Thank you very much. I mean, I would like to be very flexible to fit in within 10 minutes. So, I mean, Chile has been always of my interest because, Chile is well known, as Fernando said, for its effectiveness of their, framework for the fiscal management. I mean, of course, the aim of the efforts of the governments to raise, I mean, to enhance the quality of fiscal framework is to achieve the effectiveness, I mean, consistency and transparency. So, although we are going to talk about more in details about the challenges and issues that the Korean government faces, but maybe it is right time to compare the Chilean practice with the Korean practice about the fiscal, reform initiatives. So, I mean, Chile seems to be equipped with a very effective, fiscal management framework with the very clear fiscal rules and, very innovative, independent fiscal council and so on. They have, from the very macro level, rule-based approach, and also they are very strong in the micro level management as well. But in Korea, compared to that, Korea has no clear explicit fiscal rule yet. But to me, it is more like the micromanaging the fiscal operation. So, to compare with the Chilean practice with Korea case, I'd like to share the knowledge and experience of the fiscal management in Korea. So there was the reform initiative introduced about 2 decades ago in Korea. So back then, they introduced 4 pillars of fiscal reforms. One of them was the introducing the medium-term expenditure framework, so that the budget authority actually forecast the budget need for the next 5 years, and they try to organize all those budget formulation for those medium terms. And also the second one was the top-down budgeting. So in that case, the budget authority actually set the ceiling for the budgetary expenditure for each line ministry, and actually it gives the autonomy and authority to the line ministries, so that within the ceiling they can formulate their own budget. The third one is the introducing the performance evaluation system. So for those budgetary expenditure programs and projects, they actually evaluate the performance ex post, and they try to find a better approach and adjustment measures to improve the effectiveness of the programs. And lastly, they introduced the digital budget accounting system. So it is the IT system that real time you can monitor the budget formulation and expenditure and all those, which is namely the D-Brain, to enhance the transparency of the fiscal management. So that those measures are quite effective in Korea, although it is not the high-level macro type of rule-based approach, but those are pretty working pretty well in Korea as some sort of rules and measures to improve the effectiveness of the fiscal management. So if you go down below to the micro level, so at the project or program level, I mean, Chile is well known for their effectiveness in the public investment management, which is the subset of the public finance management. So I believe under the guidance of the fiscal rules and structural balance rule and all those guidance actually trickles down to the micro level program and project level management of capital expenditure and public investment. So both countries, Chile and Korea, were diagnosed by the World Bank, like the early 2010s, to have very effective the public investment management system. So, those are similarities between these two countries. And those are some sort of comments on it. And my questions about, the presentation of the Chilean case is just out of curiosity, what made Chile different from, similar Latin American countries? What are the historical background and country-specific context that Chile can achieve that type of very effective system and rules? And related to that, what can the developing countries to do to follow those nice practice in Chile? And lastly, some sort of from the political aspect, how can Chile ensure and maintain the independence of autonomous fiscal council? That are the questions that I can raise. Thank you very much for your wonderful presentations.
Okay, thank you. Before we turn our microphone to the presenters, let me have some of the questions from the floor. If there's any comments or questions from the floor, we will try to give you. So one of the staff member here is expected to bring a microphone. Yes, please, back there.
Thank you very much for your presentations. I'm very interested in the presentation from Chile. I'm from Ecuador, a country in Latin America also. And I think Chile is a good example in the fiscal policy. So I think my question is related also with the other presenter. Considering Chile's experience with establishing a structural balance rule and autonomous fiscal council, to enhance fiscal transparency and sustainability, what lessons could Ecuador draw for this model to improve its fiscal disciplines and resilience? I ask this because Ecuador has a similar scenario that depends on the price of oil and natural resources, and also is facing a lot of crises, but our fiscal policy is still in process of being constant, or have a, to be developed in a stable way, because we change all our fiscal policy depending on the government. So yeah, I want to know what is the secret of Chile to implement in Ecuador.
Thank you. Thank you for the relevant question. Professor Lim. Microphone to the front desk.
I have a question for Fernando on Chile. Wonder what Chile thought about nominal growth part of this fiscal equation, because talked about fiscal rules, but we saw that debt to GDP ratio rising since 2007, and also with the target debt to GDP ratio of 45% and structural budget rule at like 0.3%, the implied nominal growth seems to be very low, because going back to Maastricht, if you have a debt to GDP ratio of 60% and a deficit of 3%, the implied nominal growth rate is 5%, right? So what do Chileans think about the growth aspect of fiscal policy? And is there any pushback from academics or others that even though Chile has a good fiscal council and fiscal rules, they probably underachieved on the growth aspects? So I just want to hear about the national debate within Chile on that issue.
Okay, thank you. Any final question or comments? Okay.
Okay. Yes, I think that the we can merge the question of my colleague from Ecuador and your question on what makes Chile different. And I think that this is a clear, a very difficult question to answer. But I would say that for me was the political consensus that other countries in Latin America didn't have. When Chile transitioned to the democracy after 20 years, very, very hard dictatorship, everybody thought now Chile will go bad because it was a lot of social pressures for increasing expenditures, also the freedom, liberty, the left-right government or positions. After 15 years of dictatorship, they have a political situation in their favor. But they, and then when the first democratic government that was a coalition government of center-right and left, they were very prudent and say, no, we need to distinguish what was the bad of the dictatorship, that was 80% of things doing wrong, but we need to keep the 20% that the dictatorship did well, that was the fiscal discipline. And they were even more disciplined than in the dictatorship, the fiscal management, and was because they had this very broad coalition and say, we will not touch on the things that are working well. And that, I think, that was a demonstration of the maturity of the political system in Chile. Because in other parties, in Latin America, in Argentina, Bolivia, my country, when we recovered the democracy, it was a mismanagement, a complete mismanagement on the fiscal side, no? And it was not the case of Chile. They keep the things working well. They know we will, even the rule, all the things that I showed, were done by the democratic government, not by the dictatorship. They say, okay, no, we need to, fiscal discipline is a good that we cannot just discard, because that was the important thing. And this is what I don't see in other countries, this consensus. Up to now, in Chile, the discussion of fiscal policy is very different than in other countries. In countries that I work, in my country, the discussion is if deficit is good or bad. In Chile, they don't discuss that. What they discuss is allocation of resources. And this is linked to the word of, with the question of growth. Why Chile, I think that like Korea, they are experiencing an stagnation, an economic stagnation that is taking almost 10 years in Chile, since 2000, mid-2010, they are stagnated. And the question is, productivity is not growing in Chile at all. And perhaps in Korea is the same. But what they know is that fiscal policy cannot be an instrument to just accelerate economic growth for 1-2 years, and then you have you will have another problem. They know that fiscal policy can do something, improve during the cycle, do the stabilization role, but cannot go beyond trying to make the state, to impulse growth from the public sector. So they know that they are facing challenges. This is a big challenge that they have on why they are not growing. And if you see why they were accumulating debt despite all this system, is because growth was very bad in all this period. And the calculation that they had a potential GDP growth rate of 5% was not true. It's much lower. They didn't recognize that the potential growth of Chile is around 2%. So their fiscal targets needed to be more conservative. But they were insisting in that they have that, and they couldn't have that. And this is why debt was accumulating. Other interesting thing that perhaps is linked, I see Korea and Chile very similar in several aspects. No? They experienced a very high growth period, very good things happening, and the stagnation that countries are suffering. And reading the presentation that I need to comment in the afternoon, one of the issues of fiscal rules is the pension. Chile resolved the problem of the problem of the pension with the wealth fund. They say, okay, we will do the transition from the from the as pay as you go system to the fully funded system, and we will have a fiscal cost of that. The cost was like 14% of GDP at that time. And this makes impossible any reform if you don't have the money to do it. But they had the privatization proceeds, and part of the wealth fund was separated, what they call the social fund. a social, the well fund has two components, the stabilization part and the social fund. And the social fund is to pay the pensions of the people that already retired but don't have the equivalent contribution from active personnel. So they use that to do the transition to a system, and that was successful. And even that, they already are reforming the social system, because the pensions in the fully funded system are not allowing people to live with the level of pension that they have, and this is something that they are correcting.
Okay, thank you very much. As you all have enjoyed, the presentation was very enjoyable and very intuitive. And I think both institutional arrangements and politics are important for the success of this fiscal rule. I think that has been a major lesson from this session. Thank you very much. That wraps up this session, and I turn my microphone to the organizer.
Thank you all for an engaging session, and let's give another round of applause to the moderator and speakers. We will now proceed to the Fireside chat on international experiences instituting fiscal rules. And this discussion will move beyond theory to share concrete lessons, practical challenges, and evolving perspective from countries that have implemented fiscal rules. And now we'll take a few moments to prepare the stage for the next session.
Hello, thank you. Before starting, we are waiting for Fernando, but maybe we can start with a short presentation on the Korean experience. So we are reacting more than thinking about what the framework and the fiscal rule in Korea looks like.
Thank you, Stefano. Actually, I'm going to talk about fiscal rules in a broader context. The afternoon session is devoted to fiscal rules in Korea. So I'd like to start my 4-slide presentation, very brief presentation, if someone can upload it. Yeah, okay. So I'll offer a somewhat skeptical and critical view on fiscal rules. My point is that it's better to focus on the economics and politics of tax cuts and social spending rather than spending a lot of time on fiscal rules per se. Okay. So, as the summary slide shows, I think there have been key underlying problems that cause fiscal issues, especially in advanced industrial countries, but also in developing countries as well. First is tax cuts based on voodoo economics, a memorable phrase given by George Herbert Walker Bush on Ronald Reagan's tax cuts. Second key issue is generous pension and health insurance. Third is massive spending on military and other discretionary items. And fourth is excessive stimulus spending. Okay, so if these are underlying problems, right, based on experiences in various countries over the past 4 decades or so, what is a solution, right? And I put solution in scare quotation marks because imposing discipline by introducing fiscal rules, be they on budget balance, debt expenditure, and or revenue, without really addressing the underlying problems is not going to be a solution. That's my main point. And in fact, having such fiscal rules without really addressing the underlying problems I mentioned may actually create a side effect. Because if you're just leaving the tax cuts on voodoo economics, generous pension, and so on, but trigger thresholds implicit in fiscal rules, the likely side effect, I argue, is that then the government would say, I mean, our fiscal rules are binding, so we have to look for ways to cut spending. But more often than not, that will lead to the squeezing of the middle class and younger generation to satisfy fiscal rules instead of establishing fair taxation and reining in social spending. So my key point is that instead of dwelling so much on fiscal rules, we have to address the underlying problems directly. And my policy recommendations go as follows. Provide economic evidence and mobilize political support against irresponsible tax cuts and unfair taxation, as well as overly generous social spending and excessive discretionary spending. So this, I argue, is better for public communication too, because as Fernando mentioned, when we dwell on fiscal rules, we quickly talk about, target debt to GDP ratio of 60%, structural budget rule of 3% and so on. And then you have to convince the public why the target ratios, 60% for debt and 3% for deficit, are chosen, why they could be justified and so on. But I think the better approach for public communication too is to talk about fairness, actually. So about a decade and a little more than a decade ago, Warren Buffett, the wise man of Omaha, the investor, talked about the fact that his effective tax rate is actually lower than his secretary's. Okay? So when you have issues with taxation, tax revenue, the thing to do is broaden the tax base, have a better social contract in that instead of exempting a large proportion of population or firms from paying any tax, pay at least some tax, right, for the service provided by the government, but also hold the government accountable for the money the taxpayers paid. So it's better to have a better social contract on that front and also aim for fair taxation on tax rates and so on. Secondly, on social spending, move toward a fully funded pension system and social insurance against health risks as well as old age poverty. Okay. Instead of going with pay-as-you-go and allowing older people to enjoy benefits that are multiple times their contributions at the expense of younger people. That's unfair, okay? So in Korea, for example, we introduced a national pension in 1988 in order for people to join the national pension without much resistance. The government at the time designed it in very generous terms. Roughly speaking, you get about more than three times the value of your contributions when you retire, after you retire, in present value terms, right? If the population is increasing, right, that could be sustained. But if the population is decreasing, as Korea is, and Japan is, and a number of other countries are, that kind of system cannot be sustained, okay? So it's better to have a fully funded pension system and address old age poverty directly through social insurance. Now, the issue there on pension reform, as Fernando alluded to when he talked about Chilean case, if you have a bifurcated system where you sort of grandfather the existing pension scheme and then start a new scheme that's fully funded, you need a massive fiscal injection. I mean, in Chilean case, you mentioned it was 14% of GDP. In Korea, it'll be pretty large as well. So do you really have the money to do that is a big question, okay? And as a result, instead of going full reform, in Korea, what we did was we tried to raise the retirement age, the reception age, and change some parameters on the side. And also, we introduced what is called the basic pension in 2008 to address old age poverty. I mean, given that national pension started only in 1988, and a lot of people did not join the national pension, like self-employed people, informal workers, and so on. So old age poverty was a reality too. So in 2008, we introduced the basic pension, through which bottom 70% of people over the age of 65 and above, I should say, receive your basic amount, okay? When we introduced it back in 2008, I think the total amount devoted to basic pension was 8 trillion won, but last year it was like 24 trillion won. So on that front, we also need to reform in that instead of offering money, basic pension for bottom 70%, probably we need to reduce the recipients rather than bottom 70%, maybe bottom 30% or 40% based on means testing. Because yes, there is old age income poverty, but if you actually take into account assets that old people have in greater amount than younger generation, the picture you have of old age poverty changes. So those are the issues on pension. And last but not least, there are a couple of issues. For military and other discretionary spending, I think it's important to limit them proportional to assess risks. So for example, if you are Portugal or Spain, right, as opposed to Poland or Baltic states, the risks you face in military terms are probably smaller than those countries, right? And insisting on spending, say, 5% of GDP on defense, regardless of your assessed risks, would be counterproductive. In addition, we should also limit countercyclical stimulus spending proportional to GDP gap. And in the remaining time, I'm just going to show some pictures from the United States. So this is the long view of U.S. national debt to GDP ratio. As you can see, it peaked right at the end of World War II, so over 100% debt to GDP ratio. It came down rapidly in the post-1945 period, thanks to some inflation and robust real growth. Okay. And then, as you see, in the early 1980s, with Reagan's tax cuts, it began to rise. Okay? So debt to GDP ratio came close to about 50% by the mid-1990s. That's when in the United States, you had Newt Gingrich, Republicans, and Bill Clinton, Democrats. They agreed to make concerted effort to bring down the debt, turning welfare into workfare, and also refraining from more tax cuts. So as a result, in the second half of the 1990s, you see U.S. national debt to GDP ratio coming down from about 50% to 30%. But then when George W. Bush administration came in 2001, they instituted massive tax cuts, and as you know, there were two wars against Iraq and Afghanistan, and that quickly raised the debt to GDP ratio. And currently, at the end of 2024, U.S. debt to GDP ratio is 98%, and if you include contingent liabilities like Social Security payments, it's 120%. And it's not a pretty picture because you can look at U.S. annual budget deficit as a percent of GDP too. As you can see, since 2000, revenue as percent of GDP hovered around 15%, even as spending increased, as you can see, fairly steadily. Okay, and the blue part is the net interest payment. So you probably heard from news that U.S. net interest payment exceeded $1 trillion in the latest fiscal year, and it exceeds defense spending. And that's the reality of U.S. annual budget deficit. And the last picture I'll show you is a simulation on U.S. debt to GDP ratio by a bipartisan Committee on Responsible Federal Budget, CRFB. The basic thing, what they did was as follows. Suppose the Gingrich Republicans and Clinton Democrats policies had continued, right, even after 2000, right? Then you would have underlying debt to GDP ratio in gray color, declining steadily from about 30% to close to zero by 2020. However, in reality, you had George W. Bush administration instituting tax cuts and increasing discretionary spending. So you have major tax cuts colored in light blue. So that adds to the debt to GDP ratio. In addition, you have in red increase in discretionary spending, military spending as well as social protection and so on. That adds another 30% percentage points or so. And lastly, but not the least, is the counter-cyclical recessionary response. In the wake of the global financial crisis, the counter-cyclical response was insufficient. But in the wake of the COVID-19 pandemic, a lot of people argue that counter-cyclical spending was excessive. In fact, I remember Larry Summers saying in the spring of 2020 that according to his estimation, GDP gap at the time was about 4%, but the United States was about to spend about 13% of GDP as a counter-cyclical measure. So all these added up and created the massive national debt to GDP ratio for the United States. And the thing is, you could have had fiscal rules, but the thing is, if you violate the spirit of bipartisan cooperation that had led to the reduction in debt to GDP ratio in the second half of the 1990s and other political moves like that, I wonder how sustainable such fiscal rules would be. And instead, it would be better to attack the fair taxation problem as well as overly generous social spending problem directly. So, thank you.
Thank you. Very interesting presentation. Maybe in the spirit of this session, we can be the lead discussant on your presentation. If we can have the first slide, I think an important point that I would like to make is that what you are proposing, it's important, but the fiscal rules and your proposals are not mutually inconsistent. I think when you look at, I think your first point was on taxes. When you look at the fiscal rules that really are not binding on tax is the spending rule. The debt rule, the balance rules, all have an incentive for the government to act, not only on the spending side on the level, but also to look at how can we generate revenues to reduce debt and to support the spending that the country needs. I forgot the other points, but I think there were four points. I think the other important point that I would like, maybe the previous one, yeah. Okay, maybe the other point that I would like to emphasize is that fiscal rules are not set in isolation, and clearly there are drivers and structural issues in the economy that need to be considered when a fiscal rule is put in place. Clearly, there was a famous American economist, Herbert Stein, who actually said, if there is a fiscal discipline, you don't need a fiscal rule, and if there isn't, then why bother, no, with the fiscal rule? But I think, that the solution to impose discipline, and maybe it's old style of thinking about the fiscal rules. The objective or the primary objective is to provide an avenue for a discussion among the two aisles of the parliament and as well as the civil society on the fiscal contract, and where we could address social issues, spending from a number of social, economic, or military objectives with the revenues that the country has, and clearly, you are pointing on some very specific issues in Korea. I won't get into those, but the aging, intergenerational equity, whether to invest on future generation or thinking about the old generations, are all aspects that they go beyond the fiscal rule. At the end of the day, the fiscal rule is just a tool that can help build the track record that is needed, regardless all those issues, for a government to have a borrowing cost less than what they would have without a fiscal rule, or to have a track record that help with the intergenerational, with the timing consistency that Fernando was mentioned. You made an example of the U.S. Maybe a couple of points on the last slide. I think the first important point that I would like to emphasize is that for monetary policy to work, you need at least 20 to 30% of debt, because you need to have, you cannot go to zero. Second, I think I agree with you on the recession response. Clearly, in 2008, there was a very limited space for that response, very limited political will to do a fiscal response, and the discussion at the G20 was all about are we doing the same of 1932 recession, just using monetary policy because it's easy, than fiscal policy that is more effective. And for COVID, clearly the monetary response was perhaps lagging in US. Let me stop here. I don't know if Fernando wants to add anything.
Can we go to the slides again, please? Yes, I would say that I fully agree with the first point. Fiscal rules will not resolve problems of taxation, pension, and health insurance. Also, I fully agree. I tend to disagree with this, with the last point, because as you say, fiscal rules are not the bullet point that will resolve all these things. These things need to be resolved in another way. Fully agree. But fiscal rules can will not provide the result that you said, likely outcome, because this is a discussion on on the things, on the priorities, on the social contract, on what you will cut. And even if you don't have fiscal rules, the result will be the same. If all the parliament and the society, they find that we will punish younger generations, because normally what happens is that the kids don't vote. So they cannot, and the old vote, and they have the mobility. This is independent of having fiscal rules. If you say, okay, we cannot resolve this problem with fiscal rules, the likely account, you cannot responsibilize a fiscal rules for doing that. So I think that I agree with the need to tackle the structural problems in fiscal policy that are beyond the fiscal rule. The fiscal rule is not a silver bullet to resolve all these type of things, but you cannot say that basically the allocation of resources are affected by the fiscal rule. So that is one of the points. And if you go to the last graph, or the third graph that you have, this one is the two shows the same, no? More or less. And the idea that for me the scenario that alternative scenario that you can put is if U.S. would have effective fiscal rule. Perhaps all these type of things you can avoid. First, if they would have a good escape clause, they would not do the crazy things that they did after COVID to expand expenditures. Because if they would have a escape clause saying, okay, we are in an extraordinary situation, we need to act, but not, the sky is not the limit. So a good escape clause would help them to not to expand as they expanded, no? So that is one thing that a fiscal rule can do in the case of the US. The second thing that is very important is the reduction on taxation. If you have even not a perfect rule, a balanced rule that they don't have, you can say, okay, you can cut taxes to the rich, but you will need to increase taxes on other ways or reduce expenditures, not to do just that, because this will increase the deficit. So that fiscal rules can help. No, I am fully agree that perhaps I am too optimistic with fiscal rules in the current US political context, but at least fiscal rules can give you I would say increase the cost, the political cost of deviation, a fiscal rule. At the end, you say, okay, you need to explain. I want to cut taxation for the rich because I want to do that. But if I am violating a fiscal rules, I need to explain why I am violating and what is the result of that. That are the important things on fiscal rules, no? And I think that could be helpful. I am not saying that will resolve all the problems, but at least will increase the cost of deviation. This is the minimum effect of a fiscal rule. When you do a policy decision or to increase military expenditure, if I have a rule, I say, okay, I cannot increase to 5% of GDP because I will violate all my things. And if I believe that this is important, I need to explain better to the society, no? that is the case. So I think that I agree that fiscal rules don't resolve things, but can at least be a mechanism device to avoid this type of deviations that you highlighted.
Yeah, in response, what I'd like to say to Stefano and Fernando is as follows. In this slide, what I like to highlight is the blue part, actually. So these are the key underlying problems we agree on. And in order to address those underlying problems, what I emphasize the most is providing economic evidence and mobilizing political support against, irresponsible tax cuts and unfair taxation, as well as generous social spending. And there, that effort should be based on the notion of fairness that's shared by the community in the local context, in my view. Because one practical problem we've been having with fiscal rules is that you have to explain to the general public why the target debt ratio, debt to GDP ratio of 60% is correct, structural balance ratio of 3% is correct, and so on. Because pretty soon people will say, well, we see all these advanced industrial countries having debt to GDP ratio that's much, much greater than 60%. And we like to have flexibility on balance rules and so on. So instead of getting to the technical aspects of fiscal rules thresholds, actually, I think it's important to focus on the fair taxation as well as intergenerational equity to really drive the reform efforts, and also encourage younger people to vote, which is quite critical in this context. So I agree with you that fiscal rules could provide a useful trigger and some constraint. But more often than not, politicians say that they are elected by voters. These are our current needs and so on. So in order to counteract that, I think it's more important to highlight the notion of fairness and mobilize political support for pension reform and the tax reform, instead of dwelling so much on the technical details of fiscal rules. So that's the way I would phrase it.
Thank you. I think we conclude here. Lunch is on the way, I understand. And thank you again for this very interesting conversation. Thank you.
Thank you very much. We'll now take a lunch break, and the lunches will be served at your tables. And after your meal, please feel free to chat with the World Bank team for the remaining time. And the afternoon session will begin at 2:15. Welcome back, everyone. We will now begin session 6, Fiscal Rules in Korea, Challenges and the Way Forward. And this session will explore Korea's fiscal rules, discussing why explicit rules are needed and what types of should be considered, and the thresholds relevant for Korea's mid to long-term economic outlook. Now I would like to invite our session moderator, Dr. Franz Roof, along with our speakers, Dr. Chol Liu, Dr. Kang-gu Lee, Dr. Taesuk Lee, Dr. No Park, and our discussant, Dr. Fernando Cosio.
Okay, good afternoon, everyone. I hope you had a good lunch. And now we'll be moving on to the Korean experience with fiscal rules. First up, we have Professor Chol Liu from the KDI School of Public Policy and Management, and he'll be doing a presentation on fiscal rules and constitutional reform in Korea.
Do I have to start? Yes, all right. Could you play my presentation slides? I cannot see. Here. Okay, the title of my presentation is Fiscal Rules and Constitutional Reform in Korea. Basically, my presentation is about how to balance fiscal democracy and executive discipline. And I think this topic is very timely because the first national policy agenda of the current administration of Korea is constitutional amendment, right? Okay. Yes, sometimes we have to read poems, right? So, this is the poem, it's about Pandora. So I will read it. Hephaestus shaped her from earth and rain, fair as the deathless goddess in grace. Athena clothed her, and the Graces crowned her. Aphrodite breathed desire upon her face. Hermes gave her voices both sweet and slight. All gods bestowed their gifts and named her Pandora. Pandora was assumed as all gifted, but when she lifted the jar, the lid of the jar with her hands, she scattered the evils that bring sorrow to man. Now, when I participated in many discussions about the amending Korea's fiscal constitution, I found that they heavily rely on the U.S. model of budget reform, and some view that U.S. federal system as all gifted, and some believe adopting the U.S.-style budget process will solve all the problems. But my question is the U.S. model truly all gifted, like Pandora? And this slide will show you the historical evolution and reform context of Korean constitution. We made the constitution in 1984, and since 1984, we made 9 amendments. But despite these 9 constitutional amendments since 1948, fiscal clauses have remained substantially unchanged. So the experts generally agree that our fiscal constitutional reform must aim to balance democratic accountability and fiscal discipline together. So there are 2 core fiscal provisions in the Constitution under review. The first one is Article 54. The second one is Article 57. And Article 54 grants executive branch exclusive authority over budget formulation, and National Assembly can only deliberate and approve the budget. And then Article 57 is known as Executive Consent Clause. So without executive consent, National Assembly cannot increase any items of expenditure, and National Assembly cannot create any new items of expenditure. To my understanding, Article 57 have been working as Korea's a de facto fiscal rule. And Korean system is non-statutory system, which means the Korean budgets are not enacted as formal law. And during the discussions, the many constitutional, especially fiscal constitutional reform proposals was suggested, and most of them rely on the US-style system. They introduce statutory budget system, which means they want to introduce budget legalism into Korea, and also they want to ease the executive consent requirement, and they want to give more power to the National Assembly in budgeting. So my question is, would adopting US-style fiscal rules and a budget system ensure both democratic accountability and fiscal soundness in Korea? So there are multiple types of US fiscal rules. They have budget balance rule, expenditure rule, pay-go rule, and debt limit. And a budget balance rule targeted deficit reduction for a balanced budget, and they introduced sequestration for a deficit target violation. And expenditure rules limit spending amount, and the major examples are Budget Enforcement Act and Budget Control Act. And pay-go rule requires deficit neutral for legislation, and the pay-go rule became permanent by Statutory Pay-as-you-go Act in 2010. And finally, that limit total government debt accumulation. So we have many and numerous fiscal rules, and the most US fiscal rules are statutory, not constitutional. And then let's examine the performance and effectiveness of US-style fiscal rules. So you can see the US fiscal balance and debt trends. Here we have 2 clear findings. The first one is chronic deficit, and the other one is debt growth. The US has consistently run deficits with brief exceptions when economy is good and economy is bad. And publicly held federal debt reaches almost 100% of GDP by fiscal year 2024. So from these data, we can say that the US fiscal rules were not effective. And many US fiscal rules have proved ineffective due to various ways to bypass them. So they exempted specific items or many items from rule coverage, and they continuously raised spending limits, and also they postponed automatic spending by delaying sequestration introduction, and they increased statutory debt limit constantly. So to my understanding, the root cause of the ineffectiveness of US fiscal rule is lack of political will. It means that if there is a political will to bypass the rules or succumb to the rule, mechanisms will be found, and actually they found the mechanism to bypass them. So, and then what are the consequences of the US-style budget process and legislature-led resource allocation? There are many problems. The first one is omnibus bills, and the second one is earmarks or pork barrel. Omnibus appropriations means when regular appropriations bill aren't finalized, multiple bills consolidate into large omnibus act. So they become a Christmas tree bills with numerous difficult to pass provisions, and it make the budget larger and larger. And earmarks and pork barrel mean they are budget allocations for specific projects in particular states and particular districts. And it has many negative impacts on American budget. So in 2011, the Congress declared moratorium for all earmarks. But since 2021, the earmarks were reintroduced under the name of community project funding. But from the data, you can see that there will be possibility that earmarks will increase more than the threshold soon. And continuing resolution and shutdowns. So CR, continuing resolutions, are used when regular appropriations bill are not enacted until the new fiscal year starts. This is the provisional funding for basic operations of the government. But this is the emergency instrument, but this emergency instrument have become a routine practice. So every year they issue CRs. And if the government fails to issue CR, then government shutdowns. And there were 5 major shutdowns during the period from 1995 to 2023. And the longest one was 35 days in 2018. And the shutdowns have economic and fiscal costs, and the CBO estimated the cost of shutdown in 2018 was about $11 billion US, and that is about 0.1 to 0.2% of annual GDP. And now we know that currently the US federal government is under another shutdown since October 1st. And that limit crisis. And since 1940, the statutory debt limit has been adjusted or changed or lifted about 98 times. So 88 increases and 10 suspensions. So to me, what's the meaning of the rule of that limit? And then that limit brinkmanship resulted in credit rating downgrades in 2011, in 2023, and 2025. So they emphasize that political grid work and high debt and rising interest costs of the federal government is really risky. And under the budget legalism system, we have another problems. They are policy riders and low rolling. And policy riders mean non-budgetary provisions attached to must-pass appropriations bills. So they are tied to essential funding, and eventually, they make the resource allocation very rigid. And local ruling practices are vote trading between Congress members to exchange support for each other's provisions. So they can result in larger overall budget than if items were considered individually. And this is a summary of US fiscal management issues. So we have many evils here, evils scatter, and chronic deficit bias, omnibus appropriations, earmarks or poke battle, continuing resolutions, government shutdown, debt limit crisis, credit rating downgrade, and policy riders. So fiscal rules without credible political commitment are easily bypassed. And these problems are amplified in politically divided government like Korea. The US statutory disciplines demonstrate how easily the budget process can be distorted. Korea must learn from American cases. By the way, how has Korea's fiscal health fared under its current constitutional framework? I know there are many concerns about the fiscal health deterioration in Korea, but according to the data, South Korea has maintained low debt ratios and stable deficit among OECD countries. So, to my understanding, the executive consent clause, the Article 57 of the Constitution, has served as a constitutional safeguard against populist spending pressure. The Korea has historically avoided chronic deficit without relying on statutory rules. So we have to think about introducing statutory fiscal rules, but also the more important thing is we have to keep our constitutional fiscal rule first. To my understanding, the American style reform is not all gifted. Revising Article 57 could unleash fiscal populism with consequences that are politically and economically costly to address. So we have to remember that a reform filled with noble intentions may unleash unpredictable consequences like opening Pandora's box. Korea's current fiscal constitution offers several strengths, balancing power between executive branches and legislative branches, and preventing shutdowns, and correcting deficit bias, and curbing poke battle, and fostering mutual accountability between the branches. And also we can maintain investors' confidence and preventing credit rating downgrades. So my conclusion and my final question is, who dares to open Pandora's box and unleash all the evils by undermining the fiscal constitution? Thank you very much.
Thank you, Professor. Next, we have Dr. Kang-Koo Lee, who's a senior fellow at KDI, and he'll be speaking about the effectiveness of major fiscal rule types, international evidence, and implications for Korea. Please.
Good afternoon. I'm Kang-Koo Lee from KDI. I will show you today is effectiveness of major fiscal rule type, international evidence using EU data, and implication for Korea. So thank you to World Bank and KDI School for hosting. Here is today's roadmap. First, I will why Korea need fiscal rule. Already the Professor Liu said it, but I show you the visually first. And second is empirical evidence by rule type, using EU data. And third is key consideration for Korea's fiscal rule adoption. So why Korea need a fiscal rule? Korea, like other major countries, we have expansionary fiscal policy and monetary policy to respond to COVID-19. So after 2020, we have government debt increase. And since COVID-19, Korea has continued to run a huge fiscal deficit. You can see the minus deficit after 2020. And the share of mandatory spending, that is, the legally required spending has increased. So mandatory spending is red box. So mandatory spending is exceed 50% of total expenditure since 2018. So mandatory spending needs to we need to adapt the fiscal law with legal force, so fighting the mandatory spending increasing. And here is the demographic change in Korea. So Korea is facing long-term demographic changing with low birth rate and population aging. So in 1980, we have the triangle shape in population pyramid. And nowadays, in 2020, we have a diamond shape of a population pyramid. And after 25 years later, in 2050, we have inverted triangle shape. So Korean government in this year project government debt to exceed 150% of GDP by 2065. So had a fiscal rule been in place, it could have supported to consolidate during the after COVID recovery when reducing deficit was difficult. With rapid population aging, the revenue will be constrained and social spending will raise in long-term outlook. So fiscal law is needed to manage fiscal sustainability proactively. So here is the empirical evidence by rule type. Actually, many countries operate the different type of rule and combined rules. So actually, many countries fit their own economic condition and social conditions. So in a single fiscal rule, the most used is budget balance rule. The 93 countries use it. And that rule is 85 countries. And combined rule also used the expenditure rule plus budget balance rule, or the budget balance rule plus debt rule. I will use the data of 27 EU countries from 1990 to 2021 using the macro and public finance statistics plus fiscal rule index. Fiscal rule index is a weighted scoring index measured by rule stringency and coverage across the government levels. You can see the EU fiscal rule index. In the early 1990s, the fiscal rule index is negative numbers. But after European the fiscal crisis in 2010, and that the fiscal rule index is jumped up and positive numbers. That means very strong strong the fiscal rule and make a burden some EU countries. So I will check the short-run effect of a fiscal rule type and fiscal rule index on fiscal consolidation. So in here, consolidation we measured by the cyclical adjust balance. So in this panel regression, we have a cyclical adjust balance is increase is by the previous balance and debt, GDP gap, and fiscal rule index, and dummy variables. So Hausman test favor the fixed effect model rather than the random effect model. In the fourth row, we have a fiscal rule index show the with 3 years lag that positive numbers but not significant. So we divided the sample period before the European fiscal crisis and then after fiscal crisis. So before the European fiscal crisis, but we don't have to get the fiscal rule index is not significant result. So after European fiscal crisis, also with the 3 reg, we have a fiscal rule index is positive number, but statistically insignificant. And with 1 reg, we have a significant, but sign is different. So I will try to focus to rule type dummy. So expenditure rule, we have a positive consolidation effect and statistically positive, significant. And also revenue rule have the positive number and statistically significant, but number is smaller than expenditure rule and budget balance rule. You can see the budget balance rule also have a positive number and statistically significant. But actually, I hope that rule is best way to get consolidation, but that rule have a positive number, but insignificant. And we try to combine the rule. In the combined 2 rules, expenditure rule and budget balance rule have a positive number and significant level, but that rule is not insignificant. So I think the rule type is matter. So expenditure rule and budget balance rule have a consolidation effect, but that rule is we cannot see the consolidation effect in short run. So key consideration for Korea fiscal rule adoption. As you know, the EU Maastricht threshold is deficit is less than 3% of GDP, and debt government debt is less than 60% of GDP. So to keep the debt ratio stable is to keep the 60% debt to GDP. So usually normal growth rate is 5%. So we can get the deficit is around 3%. For Korea, we have to calibrate Korea's own threshold using the Korea's the growth rate and interest rate or demography, rather than copy them. And adoption of fiscal rule, we have benefit and drawbacks. So first benefit of fiscal rule is fiscal rule are effective tool to raise deficit and debt burden. And evidence showed the country with fiscal rule tends to have a strong fiscal balance and low debt burden. And also we have the drawback of adoption fiscal rule. The most thing is a procyclical type. So spending rise in booms and falls in downturns in some rules. However, the spending rules are generally less prone to this risk. So, especially with the well-designed escape clauses. And finally, the governance is matters. Effective monitoring and enforcement is important. And we have to establishing and strengthen the independent fiscal institution. Yeah, that's it.
Thank you. Next, we have Dr. Tae-suk Lee, who will be talking about analysis of economic effects by type of fiscal rules, focusing on fiscal cyclicality and banking crises. Please.
Thank you. Yeah. Good afternoon, everyone. I'm Tae-suk Lee from KDI. Actually, I present my previous paper. It's published in Korean Journal of Public Finance in 2023, 2 years ago. So it's an old paper because after submit this paper, I go to OECD and I spent 2 years, and recently I come back. So I don't have any material to present, so it's old. But my excuse is I used the data before the COVID-19, and after COVID-19, most of the country do not keep the fiscal rules. So I don't try to update my result because these days fiscal rule is kind of the period of the escape clause. So I concentrate on the previous the impact of the fiscal rule before the crisis, maybe first and the second generation of fiscal rule, and maybe we are trying to considering what will be the next generation fiscal will come out, but I do not consider the previous generation of the fiscal rules effect. So in the morning session, the World Bank emphasized the growth rate and the sustainability, but I'm mainly considering on the short-term effect because I have limited data. So fiscal cyclicality and risk management I considering mainly. So before I move on, but my main argument is the expenditure rule is quite significantly reduced the banking crisis risk, and balance rule marginally reduced the fiscal cyclicality. So that's my result, but yeah, that's my finding, but I will explain step by step. So motivation, so everyone know that, so including OECD country or worldwide, the phenomenon is rising debt and deficit. So most of the country has a similar fiscal challenge, especially 2008 fiscal financial crisis and COVID-19 is worsened the fiscal imbalance. And Korea's situation is relatively stable comparing other countries, but the problem is currently their level is low, like the Chile and other developing countries. But the the speed of debt rising is quite fast. So, and on top of that, as the Dr. Kanguri said, our demographic structure is extremely extraordinary. So we need some kind of institutional system. So it doesn't solve everything, but we concentrate on the long-term fiscal soundness and how to improve the institutional step to improve the guarantee the long-term fiscal soundness. So one of the policy proposal is the fiscal rule. So I want to find some kind of evidence, of empirical evidence to support the fiscal rule. So I'm considering the several positive prospect of the fiscal rule, but what I found is the fiscal cyclicality and the banking crisis probability. So I'm considering the other effect, but I don't find any interesting result. So my paper considering on the fiscal procyclicality and the systemic banking crisis probability. So research object is the, as you know, the fiscal rule doesn't have any specific rule. So there's a variety of kind of the fiscal rules. So if we include the effect of the fiscal rule, I cannot find any result. So next step is I try to spread out the types of the fiscal rule. Even I can go further, dividing structural balance and cyclical adjusted balance and other details, but I stop at the four kind of the types of fiscal rules. So expenditure, debt, yeah, I will explain later. So, and using the international panel data from 1990 to before the crisis, before the COVID event, considering the international panel data, and I report the OECD country result because it's more reliable data. So, and I derive the policy implication for fiscal framework based on my result. So, as you know, yeah, I skipped this. So I considering the expenditure, revenue, balance, delta. So in the morning session, including other presenter, there's just some limit. So I want to emphasize that is a limit. So the 3% GDP deficit rule doesn't say 3% GDP is okay. So the balance deficit must be less than the 3%. So it's a ceiling. So ordinary, the fiscal balance rule is the balance budget rule. So the target is zero deficit, but as you know, that there's some deficit bias, so there's some buffer. So buffer size is 3% or 2% or 5%. But the politician and most ordinary people think the 3% rule means the 3% is deficit is okay, and we always hit the ceiling. But the main idea is the balance rule is the main target, and if there's some extra shock, then the size of buffer is the 3% or 2%. So the exact the number of the ceiling is not important, but the point is some kind of certain amount. So like the 30% of the debt. So there's some kind of ceiling, and we want to below target, below the ceiling. So, but the most one considering about the debt is some kind of the confused with the ceiling as a target. So. Okay, and the data and methodology. Data is using the IMF, World Bank, and OECD database, and I did the two analysis. One is considering the fiscal procyclicality analysis, and second is the banking probability analysis. So first analysis, I considering the correlation between the output gap and the expenditure gap. So if it is positive, then that means the boom, we increasing the expenditure. So there's a procyclical fiscal policy. That is the best thing. So it amplifies the GDP cyclicality. So we want to counter fiscal policies. Proper one, so we want to reduce the cyclicality of the fiscal policy. That's the target. So I regress with the rule duration ratio by type, and the control I include the income class, region, and demographic, etc. And second analysis, I'm considering the dependent variable is the systematic banking crisis. There's some kind of recent literature, so I'm using that database, and I'm using the dynamic panel logic using the recent paper. Actually, they considering some kind of the non-standardity of the independent variables. So, and I include the lag crisis, growth rate, debt ratio, etc. So I do not want to provide some detailed number. The result is for the fiscal procyclicality, I found the significant positive result of the debt rule. That means the debt rule may encourage the fiscal procyclicality. So that means that if we impose the debt rule too strictly, we suffer from the too volatile output volatility. So it increases the procyclicality bias in the GDP, so it's bad for the economy. And for the balance rule, so one of the critiques for the balance rule is the balance rule could amplify the output volatility, because the balance rule means if revenue is low, then we reduce the expenditure, and if revenue is high, then we increase the expenditure. So it amplifies the output volatility. That is the naive balance rule. But as Fernando said, there's many adjustments, so cyclically adjusted and the structural balance and balance over the certain period that may reduce that kind of the side problems. So actually, the balance rule implement in reality actually reduce the procyclicality of the fiscal policy. So actually the balance rule, if we keep the balance rule, then we have fiscal space, and then we can make the proper countercyclical measure. So, and expenditure rule reduce the similar results. So actually, it stabilized the cycle, but less than the balance rule. So to reduce the procyclicality, balance rule is the best, and we worried about the side effect of the debt rule. So we cannot make some kind of adjustment for the one shot off from the balance rule. So that's the reason the balance fiscal rule is better than the debt fiscal rule to reduce the cyclicality. And second result, financial crisis probability, I emphasize the expenditure rule significantly reduced the crisis probability. And but however, the debt rule and the balance rule, no consistent or significant effect. So expenditure rule can reduce the crisis probability. So for the risk management purpose, the expenditure rule is suggested. Yeah, so that's the result. And what is the policy implications? So as I said before, the Korea's problem is not the debt level. So that growth rate is a problem, and the worst problem is that growth rate will increase rather than the decrease, considering our long-term focus, as the Dr. Lee said. And so considering Korean situation, debt rule has quite a significant side problem. So fixed debt ratio is unrealistic if we consider the demographic and the structural change. So that rule alone risk rigid and loss of flexibility. So what is the next option? So we can concentrate on the expenditure rule and the balance rule. So actually expenditure rule can reduce the banking crisis probability, and balance rule can reduce the cyclicality of the fiscal policy. So there's some significant evidence, empirical evidence. We can follow that based on that empirical result. I emphasize some kind of dual rule framework. So as Professor Lee said in the morning, we already have the form midterm framework. So we have midterm fiscal framework. So on top of that, we can include the more credible expenditure rule to cap the midterm spending growth, and on top of that, we can make some kind of some specific deficit limit. So, but that deficit limit ceiling, not the deficit that allowing that deficit. So historically we have 2% of the deficit limit, but considering EU's reference, we just relaxed to the 3%. But if we considering the recent budget allocation, nowadays the 4% deficit is normal. So maybe we must strengthen the budget balance rule to reduce the long-term risk. So that's it. And broader lesson is we need to balance the discipline and the flexibility. So nowadays we are more emphasize on the flexibility, but we need to balance the discipline and flexibility. So, and we need, if we make the fiscal rule, considering other countries' experience, so to build a strong fiscal rule, we need a simple and flexible design, and we may include the exclude clause, but with the correct mechanism and transparency. If we make the independent fiscal council, then we can increase the transparency. To keep the fiscal rule, we need support from the ordinary people. Then ordinary people must understand the logic and what's going on in the fiscal rule. So there's some kind of explainer. So independent fiscal council may do their work to increase the public understanding. Yeah, that's it.
Thank you. Our last presentation for this session is by Dr. Nowook Park, who's the Chief Audit Executive at the Korea Securities Computing Corporation. And he'll be talking about towards rule-based fiscal policy in Korea, a reform agenda.
Yeah, yes, it's my honor to be part of this very important forum between World Bank and the KDI School. For my presentation, I'll briefly go over our fiscal situation, and then our distinguished speakers talked about the need for the fiscal rules in Korea. So I will add another argument about that. And then I will kind of list up what kind of reform we need. So in Korean case, I think the letter is too small, so I can. Okay, so let me see. Especially, first of all, I think the reason why we are talking about fiscal rule, so-called rule-based fiscal policy, like rule-based monetary policy, is that especially after the global financial crisis, we realized that discretionary the fiscal policy is bringing about big challenges for the sustainability, especially even among the OECD countries at the global financial crisis. We found that there are many hidden the debts which is not reported in the government system, and we found also the debt issues in the private sector also is spill over to the public financial issues. So it's a very because of that, I think we talked about the rule-based fiscal framework globally, and then so it's the global context why we are talking about rule-based fiscal policy, and also already previous speaker, Dr. Liu mentioned that in Korean context we have a constitution which is giving the budget formulation authority to the administration, so it gives the authority to impose at least aggregate fiscal discipline to the budget process. So far, in Korean context, it has worked for us. So that's why the debt level is not high, and internationally we are well known for the very sound public financial management. But nowadays it's in question, and especially political influence becoming very strong in budget process. So also, Dr. Liu mentioned that under the current government there is some discussion to weakening the central budget authorities' power in budget formulation. And then, so I think that that direction may be required if the Korea going through the democratization process. So far in Korean context, the so-called the administrative autonomy played a role heavily, and it has been successful. But under the democratized society, we may need more transparency. So there has been multi-front attack on the authority of the central budget authority in Korea. So in response to that, we, as an expert, we are thinking that we may reform our budget fiscal framework by making it more transparent, and or also making it more rule-based rather than entirely dependent upon the autonomy of the central budget authority. So because of that broader context, I think we need to move to the rule-based fiscal framework if we undermine the central budget authority's budget formulation authority. So this is a kind of broader context why we are talking about rule-based fiscal framework. And then specifically, the Korean government is facing some fiscal issues. So far, we are okay. Also, even for the medium term, we don't have a big problem. But the big risk is coming, and it's very evident to everybody. But required reforms are delayed. So that's why we need kind of fiscal rules which can put the pressure on the decision makers. They need to do something, and also they need to choose. They need to act upon the policy priority rather than trying to do every good thing, which is infeasible. So let me see. So this is some of them are already mentioned, but big picture is that for the longer term, we have unsustainable social insurance funds, pensions and health insurance, all those things. And but in addition to that, even we have some challenges in annual budget formulation process itself. So it is manifested in the persistent annual deficit, which is between 3 or 4%, even beyond the 4% level. So this is keep going. So if we can control it, if there is a kind of pro-cyclical activities going there, that's okay. But it's always, we are now accumulating deficits, I think more than 10 years. So also government, as a result, government debt level is gradually accumulating. So also the bigger problem is that this is our medium-term budget framework. So even if we look at this, then during each period, as time goes on, it shows that there is no way we can go back to the fiscal balance. So I will not go into details of which period is exhibiting what kind of problems, but big picture is that even if we want to get back to the fiscal balance, that's not going to happen. And even in MTAPs, sometimes there is no plan for the getting back to the fiscal balance. It shows that even the medium term, our budget framework needed to be reformed. And also, in addition to that, already it also mentioned that budget rigidity is also increasing, not only for the mandatory spending, also, as you may know, as a government official, you may know, there are some rigid spending. You cannot easily cut the budget for the annual budget process. So if we look at details of the Korean budget, I found that less than 20% of discretionary spending is easily subject to the fiscal consolidation during annual budget process. So if we get back to the fiscal balance, we need a kind of institutionalized, which can bring about the structural fiscal readjustment. Otherwise, as a normal annual budget process, there is no hope for getting back to fiscal balance. So that's why we need a fiscal balance, which we hope maybe the fiscal rule may be the platform for the formulating, building the consensus among decision makers. Because in our context nowadays, the problem is that there is no consensus over the fiscal stance. Some groups saying that even if our fiscal situation is deteriorating, we have to do expansionary fiscal policy to promote economic growth, which may lessen our debt problems. But some group is saying that that's not going to work. That's a kind of wishful thinking. So that kind of disagreement is very heavily evident among decision makers. So that's why when maybe we talk about the fiscal rules, then we may think about building about the consensus, and which based on that we may do some reform programs. Otherwise, just all the reforms are delayed and nothing is happening. So if you face that problem, usually this is those things are the measures you cope with that problem. Like the first one is fiscal consolidation, which is necessary, but it can solve only part of the problems. And then you may do expansionary fiscal policy to promote economic growth, which is our current government's argument. But historically, there is you cannot find cannot find examples among the advanced countries who repaid their debt by promoting economic growth. So also there are some arguments. Recently, actually, there was argument that economic growth also raised interest rate and increased debt burdens. That kind of another channel is going there. So it's not one-way street. So it's also not a realistic option. And also we do increase tax revenues. In Korean context, there is room for tax increase, especially for the personal income tax and also for the value-added tax. But it's politically very sensitive, so no action is going on. But in Korean context, it can be one of our options. And then the last option is just default. It's a disaster, right? And then for the large countries like US or France, or which has a sovereign money or international currency, they can inflation away the debt. But for the small open economies like Korea, it's not our option. So our option is very limited. So to cope with this problem, we have to do some preemptive reforms based on fiscal rules. So already I think mentioned this, I will skip some of them. So we may need to introduce kind of stepwise process to introduce the fiscal rules. The first stage is that our current budget structure itself is now it's not in balance. So there is a gap between the revenue and the spending. So we need to restructure the budget structure itself. And then after that, if we So first fiscal rule should be how do we do some restructuring our current budget structure in the medium term will be our first goal. And then after that, we may think about more stabilized fiscal rules, like the debt anchors, and also especially after COVID-19 crisis, the third generation fiscal rules is now we are thinking that expenditure, the rule is the more practical one because it's under the control of the government. But fiscal balance rule is a very challenging rule to implement because technically, even if you can use structural balance, considering the economic cycle, but it's technically very hard. And also, according to European experience, we found that distinguishing between cycle and trend it's not an easy job. So that's why I think the European framework is moving to the expenditure rule. But to do that, I think we need the active role of the independent fiscal institutions, which is giving the diagnosing the fiscal situation and economic situation and recommending fiscal rules, and also make the process transparent. Based on that, we can manage the fiscal rule more flexibly and more credibly. So that's why I think the role of independent fiscal institutions becomes important. But in our case, in Korean context, we have National Assembly Budget Office. The Dr. Lee Kang-gu worked there, but also it's arguably their independence. They're kind of independent, but there are some argument or skepticism there. But if you want to use the independent fiscal institution closely with the budget process, to my observation, which instituted within the administration will be also independent, will be more beneficial, which can be part of the integral part of the budget process. So it's another issue we need to think about, and also other technical issues already discussed by our previous speakers. So I will stop here and then, open for your questions.
Thank you very much. Before Fernando discusses, I think the tally on the stage, although I'm not going to ask our speakers to reveal anything unless they want to, my tally is it's 3-1 for a fiscal rule in Korea. So before we move on, I'd like to ask the audience, so I'm going to do a little poll, and luckily we have a chief audit officer on stage who's going to audit it for us to make sure we get the right numbers. But so please, I'd ask you to raise your hand in two cases. First, if you think that Korea should have a fiscal rule or should adopt a fiscal rule, abstracting from the design of that fiscal rule. Can you please raise your hand? Nobody? Nobody? Okay, let me try one more time just to make sure everybody understood. So raise your hand right now if you think Korea should adopt a fiscal rule. Okay, good. Please raise your hand just to make sure it works still if you believe Korea should not adopt a fiscal rule. We've heard the experts. We've heard a lot today. So do you think, who says they should not adopt a fiscal rule? Please raise your hand. Okay. I don't think hands are working today. Okay, I think, I don't know, that seemed like 3-1 in the audience too, but I guess nobody wants to vote. Fernando, would you like to discuss? And would you also like to, as part of your discussion, tell us what you think Korea should do? And maybe tell us what you think they should do in terms of design as well. Sorry to put you on the spot.
After these very, very strong presentations, I don't know if I will vote in favor or against the establishment, even that I am advocate of fiscal rules. In this case, I think that I prefer to abstain of voting in favor or against the fiscal rule. And there is, I think, very valid, legitimate reasons in both sides. I think that the three last presentations show very clear, with evidence, that the fiscal trend of Korea is not getting good, it's worsening. That is a fact. And this is very clear, and this will suggest that the country needs a fiscal rule. But the concerns that the professor, the first presentation highlighted, I think that are very valid. And also, when you try to change or reform something that is still working well, or at least is not in crisis, it's very difficult to reform. It's the right time to reform, but you need to be very sure what you want, and also the unexpected results of any reform needs to be considered on that. It's like he said, Pandora box, and if you open, you can you can have exactly the opposite effect that you wanted with the establishment of fiscal rule. So the first thing that clear message is fiscal trends in Korea are worsening. The second concern is fiscal rules will resolve this worsening. Perhaps not, because as in the morning we discussed it, you need to correct the structural imbalances and the pension, the other things, because the fiscal rules by itself will not correct that, will not correct. And the third is that the third important lesson that we discussed also in the morning is that copying and paste other legislations, in the case the professor showed that US legislation is not a model to follow at all, and I fully agree with that. So, and in the morning I said this 3% and 60% thresholds that everybody is adopting are not scientifically defined, and also the European model is not a model to follow. The fiscal rules in Europe are too complicated, nobody understands. It's less of negotiation, and also I don't think that is a valid model to follow. So I think that we will leave this session without a clear outcome, and I think that is good. It's not necessarily bad. I think that the country needs to have to think very carefully on the options that have. It's very clear that the country needs some fiscal consolidation, needs to reverse the current trends, but that fiscal rules can be very useful on that, but they will need to be very well designed with all the things, not copy models from other countries. That will not be the solution. But at the same time, I think that will be important, and for me the most important thing is the political consensus for that. Fiscal rules also don't create the fiscal consensus. You see the US, all the problems that we are observing in the US is the result of lack of political consensus. It's a society completely divided, they call the 50-50 society. In every single debate on public policy, there are 50% in favor and 50% against. And this is trespassing all the dimensions of public policy. If Korea has this problem, I don't think that artificially inventing a fiscal rules and say, okay, no, everybody will be okay, and there is a consensus when this consensus doesn't exist, will not work. And I think that I will conclude here. Thank you.
Fernando, now I'm going to open up for questions. So do we have questions? Let's start up here.
I have a question for Professor Liu, because I want to get in more detail about Article 57 of the Constitution, an executive consent clause, or the dominance or the autonomy of central budget authority. We have a presidential system, and sometimes we have a divided government, sometimes we have a unified government, right? One would think there's some asymmetrical operation of that executive consent clause in that if the opposition has the majority in the parliament and they want to spend more, then the executive branch can stop them from spending more because of executive consent clause. But if you have a unified government where the ruling party is in the majority, then presumably the president, the ruling party can work together to convince the executive branch to allow the increase in spending. So do you see this kind of asymmetry working in practice in Korea, even with the executive consent clause you emphasized as a de facto fiscal rule in Korea?
And if I can just do a follow-up, we're going to take a few questions, then I'll ask you to answer. My follow-up question is it really the Constitution that is the disciplining factor, or is it just the institutional norms in Korea that's the disciplining factor? Wondering if you have thoughts on that. Any other questions?
Thank you so much for the presentations. My question is related to the Professor Tasuk Lee, that in the policy recommendation, he mentioned that the fiscal rules must balance the discipline and flexibility. I want to know that which kind of discipline and what type of discipline is this that you want to have this with fiscal rules? It should balance the discipline and flexibility. And the second one is about the debt and fiscal policy stability. How is the correlationship between fiscal rules and debt flexibility? You explained that even the debt rate of the South Korea was increasing, but the fiscal rules was stable on that time, if I am not wrong. So how is the correlationship between them if it is still stable and the debt rate is growing or increasing? Thank you.
Hello, thank you so much for the presentations. It was really interesting. I have a question regarding my specific situation in my country. I'm also from Latin America, from El Salvador, and it's a country where normally the institution does what the president wants. So in this specific case, do you think that to make better the fiscal rules, should we need an institution that it should be international? Because even though we have some specific type of rules that try to help the fiscal rules in our constitutions, those could be changed if the president wants it in that way. So do you think it should be an international entity so there's no way of having corruption in the change? Thank you.
Let's take those questions, then we'll come on to the next round. Professor, do you want to start? And then Dr. Tasak, do you want to go? And then I open it up to everyone to answer. Maybe Fernando, you want to have an opinion on the international organization role?
Okay, I'm not sure if I understand Professor Wonyak Lim's question correctly, but to my understanding, your question is about, is there any different behaviors impact when the government is unified or government divided, right? I didn't do any research about that, but to my understanding, it's a personally I think Ministry of Economy and Finance is working for the ministry itself, especially in Korea. For example, even when under the Moon Jae-in administration, we know that at the time the president was the liberal president, and the National Assembly, the majority was liberal politicians. But at the end of the Moon Jae-in administration, we found that when the Ministry of Economy and Finance estimated the revenue of the coming year, that actually the real the real revenue collection the coming year and the estimation November was totally different. And then because of that, I met several liberal National Assemblymen in the National Assembly, and they are the committee members at the Quebec, what is that, the budget committee, and they were really angry, and they said that they cheated us, and how that can happen. So yeah, so and then that is in the Korean budgeting system. To me, the most important issue or the critical issue is information asymmetry, which means all the budget information is possessed by Ministry of Economy and Finance. And many times I heard a lot of complaints that from the National Assembly or the politicians, then that they think that Ministry of Economy and Finance is very reluctant to share the information. So. And the other, so that is my understanding. So sometimes divided government or the unified government didn't work that meaningfully in the current context. And another very interesting, phenomenon that I found in the previous cases is. When suppose we have a politician, and he's under the liberal or the conservative the party, and when he is under the ruling party, he has something, right? But when the party became the opposition party, they have totally different opinions, and their arguments and their stance became totally different. So to my understanding, it's very difficult for us to find the consistent behaviors or consistent impacts or the results under the current situation. But I think I totally understand you are arguing a point, and that should be a very important kind of research topic and the policy implication. It has a lot of important policy implications, I think.
During your question, I talked with Professor Liu. I clearly understand what you question, but as of my understanding, you are asking the budget balance rule and the fiscal cyclicality. So I have limited time. I did not fully explain my research design. So I have some kind of a period range between the 2000 and 2019. I calculate the correlation or the regression coefficient between the output gap and the expenditure gap, and I have one number for one country, and I found some the duration, how many years one country has the balance rule or debt rule or expenditure rule, something like that. Then I regress with the correlation one number with several countries to the duration of each fiscal rule, and I found some coefficient for the balance rule. So that's my research concept. I hope it explained. And why we have the balance rule reduce the cyclicality, because we include the first generation of the balance rule is the strict balance rule. So we always balance the fiscal balance, but the next generation balance rule, we considering the over 5 year, the 3-year average of the balance. Fiscal balance fiscal deficit must be limited. then makes some kind of increasing the fiscal space. And if we considering some adverse shock in the GDP, then we have more resource, like the COVID case. Advanced country has more fiscal space, so we can actively respond to the shock. But if we have limited resource, then the power of the counter-cyclical policy is limited. So that's the reason why we may have some kind of a counter-cyclical effect of the balance rule. And yeah, that's it. Yeah. I hope if you have more questions, I can talk during the break. So.
On the question on Salvador, I think that 2 or 3 months ago, Salvador adopted a fiscal rule. It was very recent. It was one of the prior actions that the World Bank supported of the government. So there was, I think that the rule is a balanced rule. It's, the challenge is if the president will follow the rule, no? And up to now, seems that is very committed. The government is very committed in improving the fiscal framework of the country, adopting fiscal rules, improving the institutional framework of the system, etc. Are very positive signals. But as always, when we advocate for rules against discretion, is exactly to say, okay, you authorities are doing great, you are responsible, etc. But someday, somebody that doesn't have this view, that is irresponsible, that is populist, can be in office, and this is why you need rules to avoid these type of things. In several countries, when we go and say, okay, perhaps it's good to adopt a fiscal rule, they say, no, we are doing very well. We are very stable. We are very responsible. My Minister of Finance is great. It's very responsible. But things can change. And if you have full democracy, one day a less responsible government can take office, and you will. And in this situation is when the fiscal rules is needed. In situations in which you have the change, I don't know. The fiscal rule in Salvador is too young. No, it has 3 months. I don't know how committed is the government to implement. And this brings your other question: if an international institution, or if you can have somebody from outside controlling the fiscal performance of a country. In the case, if I'm not wrong, Salvador doesn't have currency. No, it's the dollar. The dollar sizes the economy. That is other way to say, okay, I am not able to control my monetary policy. I will outsource to a third country my monetary policy because they are more credible. The U.S. is more credible than Salvador. This is why I will have the dollar as my currency, so my inflation will be low. If you do the same with fiscal policy, it will be terrible. The government will not have any instrument. Already, Salvador doesn't have monetary policy. If they do the same with fiscal policy, there is no policy instrument. And this is, I would not go in this direction. Perhaps for a while you can have agreements with the IMF programs in the country, but still, these are second best solutions or third best solution. The best would be to have a rule, the government complying with the rule and creating this political consensus that the rule needs to be observed and needs to be observed in a permanent way.
Let's take another round of questions. I'll start over here.
Thank you. Mine is a more curious question because early in the presentation, there was an analogy of how the US uses fiscal policies that are statutory and not in the Constitution. And so it tends to shift differently. In the morning, the presentation gave an insight as to how having a fixed fiscal policy can impact a country. For instance, EMDs, how, because they try to balance deficits and they are spending, they are not able to invest in infrastructural development, would it then be better to have, or what would you recommend for countries to go through? Because even for the presentation for the pro-cyclical, new word, I don't know, but that word, for that presentation, I understood it to mean that some economies tend to move with their fiscal policies based on the situation, the business environment. So which would be ideal to go through? To have a statutory that is flexible when the business environment is down, then you're able to change it, or to have the constitution that strictly says what you should do?
Okay, thank you for the very interesting presentations. Both Dr. Taesuk Lee and Do Park suggested that installing the autonomous fiscal council. As an expert, what would think the optimal, shape or format of the autonomous or independent fiscal council in the Korean context? Because for the monetary policy, we have the monetary policy board at the central bank, but the independence of its organization is still, has been questionable. So I'd like to listen from your perspective. What are the optimal, format of the autonomous fiscal council if we install it? Should it be under the president's office, or should it be a public institution like the 공공기관 type of things? So I'd like to listen from you. Thank you.
Other questions? Okay, I have a question for Dr. Kang Koo. You mentioned in your presentation that the 3% and the 60% should possibly be tailored towards the Korea setup. And you mentioned a number of factors. I wonder, have you done an exercise to try to figure out maybe what those targets should be given the Korean situation? I welcome the speakers to respond. Professor Liu, I think the first one is to you.
Okay, my answer to the latest question is, in a sense, I think Korea is lucky. The meaning is, our constitution has that Article 57. That is very strong and a fundamental fiscal rule. Okay, and to my understanding, this constitutional fiscal rule worked in Korea up to now, but I don't know your case. I'm not sure if your country has that kind of constitutional provision in your constitution. So if you have that, then maintain it, sustain it. That's the most important thing, to my understanding. And when you compare the effectiveness of constitutional fiscal rule with legal or statutory fiscal rule, the constitutional one is much stronger. But a couple of months ago, we invited an expert or a scholar from Germany. And they said that they adopted that rule in their constitution, and they found that that rule in the constitution is very how can I say, it's kind of double-edged sword. If you have that kind of very strict provision in your constitution, then that system will be very rigid. So it's not very realistic. So now they think that in removing that provision from the constitution. So when you have some constitutional fiscal rule, or you have to think about this kind of trade-off. The constitutional fiscal provision will be very strong, but if that is too strict or too rigid, then you will have some very serious practical problem. So you have to consider this together. But for the statutory fiscal rules, And actually, that is not my topic today, at least. According to the American cases and American context, and personally, I believe that the American statutory fiscal rules are very ineffective. And as I said in the presentation, the political will is really important. Now, even though we have statutory rules, if we have political will to bypass it, politicians can bypass them quite simple and easily, and then the statutory fiscal rule will not work. So yeah, that is my comment to your question.
Yep. EU's the Maastricht the threshold is 60% of GDP debt to GDP ratio and 3% deficit. That from the debt equation is at that time the average European countries is 5% of nominal GDP growth. So 60% of debt to GDP times 5% of growth rate is we can get the 3% of deficit. So 1 year, just 3% of deficit increase, we stay the 60% of debt to GDP. So in Korea nowadays is 50% of debt to GDP. So nowadays the Korea's nominal GDP growth, not the real GDP growth, nominal GDP growth is 4%. So we 5% times 4%, we have deficit rate is 2%. So if we have just 1 year 2% deficit, we can increase the debt to GDP. Yes.
I just want to add the Kanguri's comment, but the Korean situation have a long-term trend. So as most of the country, the potential GDP rate is decreasing. So I don't like that kind of the calculus, but yeah, that's the reference point. But yeah, we need more sophisticated way. So we can justify the number for the existing fiscal rule, but we must considering that is some kind of a rule of thumb to guess. But for the detailed design, we must considering the other factors. So that's the reason I do not recommend that rule for in Korea case. And for the Professor Jong-Yeon Lee's question, so yeah. Independent Fiscal Council is quite a hot topic. So in OECD, so we have many research and many data set for the Fiscal Council. And I think the Dr. Nokpa will explain further, but the Dutch case and the Sweden and Irish case and the Swiss case are different. So in Swiss, the audit office, National Audit Office, work as independent fiscal council. The Irish and the Sweden, like the most EU country, they have independent fiscal council is set up, but that's not a very grand thing. Just 5 or 10 economists is making the group, and they discuss each other, and regularly they explain and publish their judgment and their comment on the fiscal stance and the fiscal rule, something like that. And Dutch case, I think the Nokbag is the expert, so I recommend the Dutch case. So yeah, you explain further.
Yeah. First, about the debt rule, to my observation, the Swedish example is very impressive. I think rather than thinking about debt limits, think about debt anchors. Like their rationale is that their debt anchor is really low. I don't know, currently I did not update, but about their debt anchor is, to my understanding, 30% plus minus 5. So it's a range, but why it's 30%? Their rationale is like that. In normal times, their sovereign debt risk premium should be equal to the German risk premium. So it's their goal. So normal times they should be stay there. So that's I think more rational the goal rather than thinking about the debt limits. And then it really affects your operational rules in your annual budget process rather than thinking about limits. If you think about limits, it's more like a long-term goal. It's not really has a direct implication for your annual budget formulation. So for the independent fiscal institution, I think the Netherlands case is really impressive for me. And also I had opportunity to talk with them a couple of days, and then they are really independent. And I think the part of the reason is that it's a socially embedded institution in Netherlands. So it has credibility among citizens. That's why if they talk, the politicians listen. They cannot easily override the recommendations from the CPB. So it has roots from history, right? After the Second World War, they developed economic development plan for the Dutch Netherlands, and it gained also the founding member is the Nobel Prize laureate. So it has it's kind of the institution in Netherlands. So even though it's just one division among in the Ministry of the Economy and Climate Change, it's just one division. It's not actually as a independent court, or it's not even located in the national in the parliament. But when its independence is not questioned. So they gave me one example that one time when there was a Brexit, then the prime minister in Netherlands announced that to induce multinational firms to locate in Amsterdam, he announced that they will lower the corporate income tax. And then 3 months later, the report from the CPB is saying that it's not going to work. So it can directly talk to the prime minister, even though it's located in the administration. It shows that how much it's independent. And also, initially the scope is very limited, but as time goes on, their work scope is expanded. And one of the dramatic examples is that they assess the election platform of the political parties. They assess it and they publish their report to the citizens to help the choice of the citizens. So even it's not in the law, it's voluntary, but politicians feel like they should do it. So I felt it's really kind of really embedded in the society. So in Korean case, the Central Budget Authority worked in that kind of it played the independent fiscal institution's role so far. So even though it's a unified government or divided government, they had their own voice so far to my observation. But now I think nowadays the Central Budget Authority is very much politicized. That's why also I agree with it should be more transparent and more participatory. So to do that, we need to move to another regime. But the key is that I think still we need some anchor within the budget process, which is independent fiscal institution. So how to secure such a technocratic autonomy in the budget process is, I think, the key for having the sound the budget process. Thank you.
Please help me in thanking our panelists and our speakers for their insightful presentations and for the discussion. Thank you very much.
Thank you very much to our speakers and discussants for an excellent session. Let's give another warm round of applause to our two moderator and speakers. We will now move on to the summing up session where the key insights from today's discussions will be highlighted and consolidated. Before we begin, we'll take a short moment to set up the stage.
Okay, I finally understood that this is actually the time and not the countdown, because I was last time expecting going down, but it was always 15 minutes. Maybe I'll start. I have just 5 points very quickly. Well, first of all, I must say that between yesterday and today, we had a very good good discussion on a number of issues, and somehow the more we go towards the end of the day, and the more interesting the discussion becomes when we start looking at case studies and real world problems. So I'll just very quickly make a few points, but at least those are my personal points. So the first one, I think the first point is really that the fiscal rules are not perfect, and we need to recognize that. There are design flaws, there are implementation problems, and the international experience, the results are quite mixed, and it's important that we look at that. So the question is not really fiscal rules, yes or no, but is more about whether they're useful and how we can maximize the benefit and minimizing the cost. The second is about, I think that the fiscal rules, as I mentioned, have limits, and they are not a substitute of fiscal discipline and the role of fiscal policy. And here I would like to emphasize is that the objective of the government is not austerity, but is to deliver efficiently and effectively public goods, and to raise financial resources to achieve this objective, whatever those objectives are. And therefore, the rules can help, but discussion on, we had it in the Fireside chat, discussion on spending and revenues are important to have. It's not either or, but they need to be complement the discussion on the fiscal rules. Then the next point is that fiscal rule shouldn't be assessed in isolation, and they need to sit on a strong legal framework and institutions with clear check and balances. And when I say sitting on a strong legal framework, thinking about all the connection that they need to be in place, there might be economic planning or economic strategy, medium-term fiscal framework, PFM, spending controls, and procurement. So to sum up, and this is really my last point, I learned a lot in the last session, but perhaps if I were the country economist and I was asked to think about this issue, for me the fiscal rules would be the last question that I would ask myself. I would start with how the economy and the society will look like in the long term. What growth model they are expecting or you are expecting, what are the demographic trends that they cannot be changed. And there at that point, I would ask, what is the role of the state in this new growth model? And what are the associated costs in terms of how much public investment I need to support this growth model? how much social protection the population is expecting, what type of pension system, regional disparities. All of them have a cost, and they need to be quantified. And finally, I would look at the revenue associated with this growth model to see how much the model can really generate. And with all of this, I would run a simple debt sustainability and see now we are at 40% of GDP in debt, I understand. Is 80 acceptable, socially acceptable for the society? If not, there are only two ways. One is to increase the revenues or to prioritize the spending. And only at that moment, I would think about, is the fiscal rule going to help me? And if the answer is yes, what type of fiscal framework I would put in place to be successful? Final comment, as Fernando mentioned, I think it is important that Korea, in this case, find a homegrown solution, or other countries. It cannot be imported from somewhere else. And building consensus, a bipartisan consensus, is necessary to make it sustainable. And I think Korea had a long history of some key points in their economic strategies that never changed, regardless which government was in power. And I think that could be something that could be considered once all those aspects are dealt with public consultation to make sure that the population support the way forward. Thank you.
I'll make 3 points, actually. First has to do with underlying fiscal problems, which I emphasized during my fireside chat. So before going into the design of fiscal rules, I think it's important to understand the sources of underlying fiscal problems. And as I highlighted, things like narrow tax base and unfair tax rules and so on could be a problem on the taxation side. Overly generous pension could be another problem. And finally, discretionary spending not proportional to the assessed risks. That could be the final problem in the underlying issues. I had a chance to talk with Dr. Kanggu Lee, during the break, and it turns out, in Korea's case, in order for us to convert the pension system into a fully funded one by bifurcating the existing pension system and then starting a fully funded one, the fiscal injection we need is on the order of 30% of GDP. So it's larger than in Chile. And the problem is, even if we stay away from such a large fiscal injection, this problem will grow, right? As long as we hold on to the existing pension system, which is based on pay-as-you-go. So we need to make some parameter changes, increase retirement age, and so on to try and reduce this, and also introduce more stringent means testing for basic pension as well, even if it may be very challenging to have a 30% of GDP as a fiscal injection, given that we don't have large amount of money lying around somewhere. The The second point I'd like to make is the tension between politicians and technocratic experts. So in a way, we like to introduce rule rather than discretion in order to address timing consistency problem and have some discipline on fiscal spending. But politicians will then say, we are the representatives of voters, and this is what they want, right? So I think there has to be, back and forth between political legitimacy based on elections and technical expertise on fiscal sustainability and so on. And the reason I asked my question to Professor Liu in the previous session was that was as follows. In my view, in Korean context, I think back in 2021, the second full year of COVID pandemic, I think we should have had a more expansionary fiscal policy with a larger supplementary budget. Okay. At the time, as Professor Liu alluded to, even though both the president and the ruling party had majority in the parliament, when the deputy prime minister at the time pushed back against the idea of having a larger supplementary budget, the president did not insist on it, okay? I think that was a mistake, actually. But at least the autonomy of Central Budget Authority was alive to the extent that the Deputy Prime Minister would talk more about fiscal soundness than response to the pandemic itself. But in the next year, in 2022, new government came in, Yoon Suk-yeol government came in May 2022, and they introduced a supplementary budget of 50 trillion won, which is about, huge amount, 2.5% of GDP. By that time, as you know, in May 2022, you had inflationary signs all over the world. And I thought that was an overkill, okay? That there should have been a better pushback from technocratic experts citing fiscal sustainability and inflationary pressures to try and resist the additional supplementary budget, but that didn't happen. And this kind of process in any country, El Salvador, Denmark, Germany, Korea, I think is critical in trying to get this question right, that between rule versus discretion. And the last session concluded on Dr. Park's remark about fiscal council. And I think that's an interesting idea. As far as I know, Korea's NABO, National Assembly Budget Office, is modeled after CBO, Congressional Budget Office in the United States. And the main objective for CBO or NABO is to look at the fiscal impact of a legislative bill introduced by members of the parliament, regardless of parties, okay? So they cannot say whether the bill is a good idea or a bad idea, but rather they would just assess in a nonpartisan way the fiscal impact of the bill itself. But in order to get the fiscal soundness right, I think the fiscal council will have to go much farther than that. And I think the Dutch example, as well as Chilean example, offer a lot of lessons for Korea, and how we could institutionally design such an institution is a big challenge going forward. My last comment is on the design of fiscal rule itself. As Dr. Tae-seok Lee highlighted, we have to look at the structural determinants of target debt ratio, deficit ratio, and so on, rather than relying on the rule of thumb. And that means looking at demographics, potential GDP, whether you have a reserve currency or not, and so on. So it's a much more complicated exercise than just looking at the relationship between the change in debt to GDP ratio versus deficit to GDP ratio and the nominal growth rate. So we have to be careful on that front. And last but not least, regardless of the thresholds we actually obtain, I think fiscal rule has is an important purpose in starting the conversation, or at least forcing the conversation on what needs to be done, right, in a substantive way to get fiscal soundness right. So even though, as I said, I'm a skeptic on fiscal rules, that purpose I can buy, and that's how I like to conclude my summary remarks on today.
Thank you.
It's a pleasure.
Thank you, Dr. Lim and Mr. Kudo, for providing a summary of today's discussions. And ladies and gentlemen, this concludes the third KDI School World Bank Conference on Fiscal Policy for Enhancing the Effectiveness of Subsidies and Fiscal Rules. We sincerely thank all our speakers, discussants, participants for their valuable contributions over the past 2 days. We would also like to remind you that the Knowledge and Training Fair will take place tomorrow at KDI School. So we encourage all interested participants to attend. And thank you, and have a wonderful evening.